Many of you have already heard us talk about the potential for synergies between the work we've done on workplace emergency savings and the expansion of auto-enrolment, which was a major theme that came through in our emergency savings summit a few weeks ago, which some of you came to. We've got a big ongoing programme of work to further build that evidence base around emergency saving and to try to support the adoption of those tools at scale. We're grateful to our strategic partner BlackRock and their emergency savings initiative for supporting that work. As I've said, with the expansion of auto-enrolment, we can't necessarily be sure of the extent to which people at the margins, especially lower earners, might be at risk of poor financial outcomes. But we all agree that in general, people need to be saving more, especially a bit further up the income range. Increasing contributions but building in an element of accessible or sidecar savings looks in this context like it could be a win-win. It creates a lower risk, less binary construct within which contributions can rise for everybody, and does so while also helping to address the critically low levels of financial resilience that we see for many low and moderate income workers today. In this sense, it's a safety valve that could allow contributions to rise without the same risk of negative impacts at the margins. I'd also like to take a minute just to highlight some other interesting innovations we've seen or become aware of around the world to bridge into how all this relates to today's agenda. So in the US, Abbott Laboratories, a large employer, realised that student debt repayments their graduate employees were making were crowding out pension saving. These employees couldn't afford to do both, but that didn't seem to them like a good reason for them to miss out on the employer pensions match. And so now anyone working in that company who chooses to repay their student debt through payroll, which in the US is a choice, is now eligible for the employer match to go into their pension just as they would have been if they were saving into the pension themselves. Again, a win-win which incentivises behaviours which improve overall financial well-being but take away that unhelpful binary choice between two different things. And this was seen as such an attractive model in the US that US regulators took proactive steps to confirm that it was legal and viable under their existing pensions legislation. The second example we're going to talk about later, which is that in South Africa some years ago, pension providers realised they had members who would not normally be able to access home loans, and they came up with the concept of pension pledging to enable people to use the fact they had retirement assets to help them to overcome that problem. I'm not going to say too much more about that now because we're going to talk about it in detail in a panel later on. And finally, closer to home, here in the UK, the University of Lincoln realised that not only were many of their student employees not eligible for auto-enrolment because of age, but probably wouldn't benefit from joining the pension scheme anyway, given the short tenure of their employment. But again, to them, that didn't feel like a good reason for them to miss out on the benefit of an employer contribution. And so they auto-enrolled this group into a workplace ISA with a matched contribution from the employer that was equivalent to what they would have had in a pension scheme. These are the kind of things that we have in mind when we talk about innovation and ways the system could become broader in supporting the whole saver to become financially healthier now and for the long term, as opposed to a narrow, almost laser-like focus on pension savings behaviours. And these are the things that we want to talk about today. So this morning we're going to talk about the wider suite of workplace financial wellbeing innovations that employers might offer alongside pensions to support with this bigger picture view, especially for those on lower and moderate incomes. That's going to include sharing some findings of exploratory research we've been doing into earned wage access and payroll-based lending. We're then going to talk about housing, which risks being a bit of an elephant in the room. How can and should the retirement system and the housing system interact? What innovations might help them to become complements rather than competitors for the scarce investable sums that people have to play with? We're going to have a keynote from the excellent Taha Choukhmane from MIT. Taha's work sits alongside that of David Laibson, James Choi, and some we've been doing as well, among others, in trying to properly understand the true whole balance sheet impact of auto-enrolment. We continue to work to bring together data from Nest and other sources to explore, for example, the relationship between pension saving and debt, and we'll be publishing some of this work soon. But overall, we need to understand what sits behind that 10 billion or 15 billion a year of new contributions. Where do they come from and how are they funded? It's an important topic and challenging one for those of us in the industry, I think, in thinking about the future of auto-enrolment, and a big driver of some of the views that I've expressed here about how we should think about that future. And at the end of the day, for those in the room only, we're going to have a Chatham House session to talk about adequacy, but specifically what can and should we be doing as an industry to come up with measures that help us to move away from that more binary pensions construct and to see the whole saver and their whole balance sheet. Okay, that's pretty much it from me, so thank you for indulging those opening remarks. I hope they'll provide some context and food for thought as well through today's agenda. I'm now going to introduce Stephanie Mastraye from the JP Morgan Chase Foundation, who is going to introduce our first speaker.
Good morning, everyone. Really happy to be here. Thanks for the introduction. I'm glad to be here to open the first session on the role employers can play in improving the financial well-being of their employees beyond pensions and savings. We have been long-term partners of Nest, and we are glad to continue to partner on new topics and innovation in advancing the financial well-being of employees. So why do we do this work? As a firm and as an employer ourselves, supporting the financial resilience of our clients, our employees and communities is a constant priority. And our philanthropic efforts do reflect these priorities as well. We have a broad mission to foster a more inclusive economy, which for a large part in the UK focuses on improving the financial resilience of our communities. So why is this work so important here? I mean, we've heard many things from the presentation this morning, but in the UK we know that 1 in 6 people have no savings at all. And in this context, helping low-paid employees build emergency savings for a rainy day is essential to help reduce the financial pressures they and their families face when unexpected expenses arise. This is why we've supported Nest since 2017 to research and try out short-term and long-term payroll savings initiatives with employers, with the Safeguard Savings Initiative and opt-in models. The project has been able to reach employees at organizations across the country and has demonstrated the benefits of growing both your pension and emergency savings pots in conjunction, as we've heard this morning. This work continues with the opt-out model with BlackRock and MAPS, and there are opportunities ahead for us to continue to see that this work will continue to have an impact in this space. But we also know that there are other areas of intervention that requires attention. Indeed, in the absence of savings, people still need safe and affordable access to money to help them manage their cash flow more easily. Nowadays, more and more employers are considering the role that they might play in supporting the financial well-being of their employees, including through earned wage access solutions, as well as various kinds of loans that can be made available in the workplace. Understanding the different models that exist is essential for employers, large and small, to decide whether they can offer these solutions in a way that is both impactful for their employees, but also manageable for them. As an example of how we've ourselves engaged in that work, in 2021 in the US, JP Morgan Chase wholesale payments team has partnered with Even in the US, an earned wage access fintech, allowing employees of participating client from investment bank to access their salary instantly alongside well-being tools. In the UK, as we expand on these approaches, and we are earlier on in that approach, we have supported Nest recently, Nest Insight, to lead exploratory research that looks at understanding how earned wage access and employer loans options are currently used and whether these options are likely to be scalable. We see this research as a first step, and similar to the Sidecar Savings Trial, it will be important to test new hybrid models to measure the impact of these approaches also in the long term. And lastly, maybe for today, a round of thank yous, of course, to the Nest Insights team for their long-term efforts, incredible work and commitment to this topic, and to all their supporters as well for making this work possible. I think we can all agree that the work in this space is far from over, but Nest findings provide valuable insight into how we can advance this agenda. I hope today's conversation can really spark more conversation and innovation in this space, and so that more individuals and households can be supported in financial well-being. I will now hand over to Sarah.
Hi everyone, my name is Taha Choukhmane. I write about employment issues at the Financial Times. I'm a columnist there and an associate editor. Really delighted to be here. Already, I've been feverishly taking notes from Will's presentation and learning a lot, and I'm looking forward to doing more in this session. That's a great introduction, so I don't think I need to do much more really. The way this is going to work is we're going to hear from each of our three panelists in turn, and then we'll have a kind of a much broader discussion, and then we'll bring in all of you with questions and answers. So if I could ask somebody to start first, and please just introduce yourselves as you begin your presentations. Thanks.
Good morning, everyone. My name is Shilpa Talana. I'm head of research at Nest Insight, and I look after a number of projects in our primary research program. As many of you know, Nest Insight has been working As as many of you know, Nest Insight has been working for several years now on a program of real-world pilots and research looking at how employee financial well-being can be supported by workplace emergency savings solutions. There's strong evidence that even a modest amount of accessible savings can meaningfully protect people from harms and improve financial health in a range of issues. For example, a savings buffer can reduce the likelihood of taking a high-cost or problem debt to deal with financial shocks and can prevent people having to turn to other detrimental solutions, such as going into essential bill arrears or even going hungry. We also find that having savings gives people peace of mind. It can reduce anxiety and stress, and this in turn can boost people's productivity in the workplace. So people want to save, but many people struggle to do so. Nest Insight has now built a really robust evidence base that the workplace is a powerful channel for supporting people to get started with saving, particularly with opt-out approaches being built in. Workplaces are an effective way to reach people where they are, and employers can be trusted intermediaries for those who might otherwise not seek out solutions at a bank or building society directly. And payroll savings enable employees to save persistently because the money moves automatically to their savings account each payday before they feel it in their pockets. In the Nest Insight Sidecar Savings Trial, we see that 99% of JARS accounts are still active after 18 months, and 3 in 4 JARS users are making a payroll contribution at that point. So we focused on workplace savings at our Emergency Savings Summit a couple of months ago, and you can catch up on that on our website if you missed it. But as Stephanie mentioned, in the absence of savings, what options do people have when they need affordable access to money to bridge a gap, manage an unexpected expense, access opportunities, or reach a life milestone? We know that many people lack savings, and that many of those who do have savings have had to use them to cope with cost of living challenges in recent months. So with funding support from the JP Morgan Chase Foundation, we've recently completed an exploratory piece of qualitative research that aimed to answer the questions of what employers can do to support their employees' financial well-being, again, beyond savings and beyond pensions. We focus specifically on earned wage access and employer loans models and how these compare with other workplace financial well-being interventions. We're also interested in how employers, providers, and employees view those options in a climate of financial precarity and anxiety. And we've also asked where this leaves us in terms of opportunities for future innovation. I'll quickly provide some definitions. When we're talking about earned wage access, we're referring to any intervention that enables employees to access some of their pay that they've already earned before their usual payday. It's sometimes known as flexible pay, salary advance, or on-demand pay. I'll be using the term earned wage access throughout today's discussion. And when we reference employer loans, we looked at a broad range of payroll-linked loans, including hardship loans, consolidation loans, and deposit loans to help with large upfront costs, and even personal loans. And these can be offered direct to the employee or offered via third-party provider. And though we're looking at these options side by side, it's important to note that earned wage access isn't a form of a loan or debt. So those definitions out of the way, our research started with looking at what we know about the needs of people on low to moderate incomes, the gaps they experience in their present and future well-being, and consequently, what entry points there are for employers to bridge those gaps. In our research, and likely in many of the conversations we've had around tables in this room, we found that much of the discussion of those needs is fairly prescriptive. It's about what low to moderate income workers need to do. Their needs get framed in terms like they need to save more, they need to spend less, they need to avoid costly debt. And these aren't strictly inaccurate in the sense that having more control over household expenditure and remaining free from problem debt could reasonably be part of a financial well-being health check. However, when we spoke to workers themselves, they didn't frame their needs in these terms. Instead, they talked about the common financial pinch points that test their resilience in the present and make their aspirations for their financial futures feel harder to reach. So we've suggested a slight reframing away from that prescriptive view, they need to do something, to what we think of as an enabling framing. And out of that come what we're calling 6 financial footings. We're aware that there are many frameworks for assessing need and segmenting populations of workers. We think this framing is useful for a couple of reasons. First, it acknowledges the fact that low to moderate income workers are making financial decisions with numerous constraints, and they often do that having fewer options than those on higher incomes. And second, we think this therefore points quite usefully to opportunities for employers. We've categorized these financial footings into needs that support resilience in the short term and those that have focused on planning for future financial well-being. So if we start with the short-term resilience, we have a financial footing that's about the need for options that don't cost people more over the long term just because they're not able to make a big upfront lump sum payment for something such as insurance or housing. We also have a financial footing that reflects the fact that some people need tools that empower them to smooth their cash flow and help reduce the stress and anxiety of variable income. And lastly, on the short term, we recognize that unexpected costs and abrupt changes in life circumstances can test people's financial resilience to a breaking point. As I mentioned, not everyone can build a savings buffer to access affordable credit or handle shocks that may come along with things such as illness, bereavement, or having to move into the private rental market at short notice. Now we have financial footings that also look at the longer term and begin to reflect not just needs but also goals and aspirations. So the first of these reflects the fact that some life events have less financial impact but are nonetheless things that require planning and budgeting. So this could be something like a holiday or the costs associated with the start of the school year. Another financial footing reflects that major life events have significant financial impacts even when they're planned for. So these are events such as welcoming a new child into the family or making a house move. And finally, we look at a financial footing around people being able to progress financially. Low and moderate income workers want to be able to set and reach a variety of financial goals, including building their savings and managing their debt and being able to progress financially. So we've used the footings in assessing the potential for earned wage access and loans. We've heard very different views about earned wage access, with some people being strongly in favor of it and others having quite clear reservations and concerns. And even loans aren't always a comfortable option for employers. In both cases, this is often because employers want to be very careful that they don't unintentionally cause harm and don't act without understanding the impact of their actions. We found in our study that some of the ways earned wage access and loans influence people's financial footings might be expected, but there are also ways that they are counterintuitive. For example, earned wage access may be best suited to address immediate short-term needs, but we also considered the potential for promoting long-term financial well-being and progression by giving employees, especially those with multiple sources of income, a tool for deciding how to use those different sources, including prioritizing certain streams of income for long-term financial planning. Likewise, deposit loans, although we think of them as meeting an upfront cost today, can play a role in long-term financial goals. A great example of this is, for example, when a childcare deposit loan supports women to return to the workplace or can facilitate a move to a better paid job. In exploring all of these options, we found, unsurprisingly, that people's choices are complex. Low and moderate income workers make decisions about how and when they might use earned wage access or a loan from their employer within a highly constrained context that includes exclusion from other credit options, uncertainty about pay and hours, downwards pressure on wages, and more recently, pressures on the cost of living and inflation. These circumstances shape people's priorities to reduce costs, reduce risk, and build security today. So this means that decision-making can be difficult. In our research, we examined how workplace loans and earned wage access fit into that difficult decision-making process, and found that people are quite sophisticated and discerning in their use of these options because their contexts are so complex. We've visualized that complexity as a metro route map, looking at the pathways that might be available to low to moderate income earners who unexpectedly need to access £250 quickly. The starting points on the left-hand side are 9 types of options or routes that people might be choosing from. The stops represent the terms and conditions, opportunities, risks, benefits, and trade-offs along each route. And the destinations on the right-hand side describe how preferable each route might be. Routes with the lowest risk and cost and which reduce the administrative burden and mental stress on the individual are preferable, even when they involve fees or disclosure to employers or others. The junctions and divergences between the pathways demonstrate that although one route might provide many of the same benefits as another, additional features can mean that it's not as attractive. So if we look, for example, savings, earned wage access, and borrowing from friends and family all have no impact on credit history. This makes them lower risk options. However, the requirement to tell someone about your financial troubles and potential negative impact on relationships distinguishes borrowing from friends and family from the other two routes. These aspects make it a route along which to proceed with caution. Other routes where caution is needed, so using a credit card or taking a loan from a high street bank, are more costly and financially risky. Likewise, the route of taking a workplace loan from a third-party provider set up by your employer meets other riskier options at a junction where there's an impact on credit score, because those third-party providers do report the history of repayments to credit agencies. However, a third-party workplace loan then rejoins the more preferable pathways, because automatic payments through payroll and the potential for hybrid borrowing and saving products makes it a good option. The most preferable route, drawing from savings, meets the needs in this scenario and is a solution that addresses all of the financial footings. However, building that savings buffer takes time, and in some cases simply isn't possible for people on lower incomes. So not all of these pathways are available to everyone, and in the absence of savings or employer-driven solutions like earned wage access or employer loans, the remaining routes are just riskier, and they also offer people the least potential for improving their financial footings, both in the near and longer terms. So what does all of this mean? Well, neither earned wage access nor workplace loans address all of workers' needs, and neither is sure to succeed or guaranteed to fail in improving the financial well-being of people on low to moderate incomes. But they do give workers more options than they would have otherwise, and sometimes can provide a route that boosts financial resilience and well-being. Where then does this leave us in a discussion about how employers can bridge financial gaps for their employees? Our research has highlighted that employers need more clarity about their obligations and more robust evidence about earned wage access in different loan models. We heard from employers we spoke to that they would value research that quantifies and expands our understanding of the pros and cons and the data about how these solutions work in practice. There is agreement that both earned wage access and employer loans are most likely to support low to moderate income workers when they're part of a comprehensive offer. Some of the innovation we've already started to see includes providing pathways from debt and earned wage access to saving. What else might be involved? And finally, this exploratory research has prompted us to ask how employer-driven solutions might help streamline employees' financial decision-making as a whole. Earned wage access and loans models give us a starting point, and examining them has helped us reframe people's needs and their complex decision-making. It's also made clear the opportunity for employers of all sizes to offer solutions that provide the right combination of accessibility, cost saving, flexibility, and timeliness that low to moderate income workers need to meet their financial goals and challenges and secure their financial footings both now and in the future. Thank you.
Good morning, everybody. I'm Sam O'Sullivan, and I'm the policy lead at the Chartered Institute of Payroll Professionals, CIPP, not to be mistaken with CIPD. So what I wanted to share with you this morning was some hot off-the-press research that we published yesterday. So as part of the policy and research team, the CIPP since 2008 have been reporting on payslip statistics. It's a really impressive piece of research. It's something that we've kept up and it's very well received within the profession. For 2023, we added in a new question around financial well-being and how that is placed within the payroll profession. So I want to share those findings with you today. So we asked the question, the survey was released in January, I believe, and we asked, do you think payroll is well placed to assist with financial well-being of employees? Well, you can see it's fairly split in regards to yes, no, and we don't know. Promising to see that the majority still say yes. And I would presume that from, the people in the room today and people online, maybe we'd be slightly disappointed with those results. We'd want to see more people saying yes and less people saying no. But I don't believe there is a correct answer as to whether financial well-being is the responsibility of an employer, and that normally is facilitated by a payroll function. Big corporates who have time, resource, the finances to implement big strategies, then yes, they will say yes. They've got the time and the resource to do it. If you think about a local business, a local butcher with 3 members of staff, maybe they're not going to think that financial well-being is their responsibility. So interesting to see the stats. I don't think there's a hard right or wrong, okay? Following on from this question, we also asked our people who responded, what's your organisation doing? So here are the results. Some of them are doing nothing. I'm guessing they're the people that responded no. And it's interesting to see that maybe these appear to be kind of outside of the box ideas as to what employers can do. It doesn't have to be earned wage access. It doesn't have to be a loan. But what could people do tomorrow that could help their employees? So on the top left, we've got allowing more hybrid and remote working. So if people are really having to commute into the office and they can do their job from home, which was kind of proven within the pandemic, why don't you let them save on the cost of travel and work from home? That really could be implemented tomorrow as long as people have got the equipment to do their job from home. Polar opposite, the top right, it also works in reverse. You could allow employees to come and work in the office if they're normally based from home. For example, height of winter, everyone's got their heating cranked up, you're using your own gas, electricity, broadband. Your employer could open the office and say, use my heating instead. It's a two-way street. You can flex it to your business needs, but also to cater to what your employees need. And Will touched on this earlier, ask individuals what they want from auto enrolment. It's the same for employers when they're thinking about financial well-being for their employees. What makes a difference to you that I can implement, that I can help out with? Some of the other ones, signposting to advice. That's financial help, financial well-being. You're increasing financial well-being of your employees. There's no cost to an employer in doing that. Maybe a bit of website development to have an extra page put on your intranet, but there's no long-term ongoing costs there. One-off bonuses, great. If employers are in a position to do that, that's fantastic. Some may not be. The cost of living crisis, employees expect an increase in their baseline salary. But the cost of living crisis is also impacting on employers as well. So they really do need to think outside the box. From the 6% that said other, those other things were loans, earned wage access, lunches. If everyone's in the office, you can provide a meal for your staff without there being an implication and giving rise to a benefit in kind, as long as it's available to all. But we won't get into the ins and outs of the tax charge. Other things that was mentioned, reviewing the benefits package as an overall review, and employee assistance programs. They're a big one, and anyone can reach them confidentially. Normally they operate 24/7. I'm sure maybe Matt's going to touch on that, so I won't go too much into it. But in summary, employers and payroll don't need to implement costly strategies to be able to help their employees. And as I walked into the room, this may be slightly cheesy, but I sat on this table and I looked at this quote over here, and it says, "How wonderful is it that nobody need wait a single moment before starting to improve the world." Okay, a bit far-fetched. It was from Anne Frank. But if you were to go back to work tomorrow, ask your employees what they need. Do you want to work from home a bit more? Would you prefer to come into the office? Do you want a free lunch while you're here? They're really quick wins. And I'm not saying in any way, shape or form that payroll can change the world, but employers can make quick win changes that will improve their employees' financial well-being. Thank you.
Hello, it's great to be here. I'm Matt Day, so I'm Wellbeing Manager at the John Lewis Partnership. So we're the UK's largest co-owned business, and it's a really special week for us this week. It's our partnership week where we celebrate us being us. So all of our employees are co-owners in the business and share both in the responsibilities and also the rewards of co-ownership. So and our business is really diverse. So many of you will know our shops, but we also run some hotels for our employees. We also have a 4,000-acre farm in Hampshire, and just really want to talk you through kind of some of the four main elements. So our business has a real rich and proud history in providing direct financial support to our partners. So for 104 years, we've provided interest-free loans and grants to our employees. But over the last 5 years, we've really moved to working more in a proactive way. So actually driving financial education, financial understanding and financial well-being, really from the idea that we care for our partners. So actually we want them to feel comfortable, to really drive overall well-being. And for us, it's really focused around what can we do to help our partners make the most of the money they have. So for me, the first of the elements is really change. So the role of employers very much is changing. I've really noticed this over the last 5 years, but not just the role of employers, also what the expectations are of employees on their employers. And for me, change also really does offer great opportunities. So within the partnership, we have a holistic wellbeing model focused around 4 pillars, so mind, body, life and soul. I look after the life pillar, so it's really driving around domestic wellbeing. So financial wellbeing is a massive part of that, but also people's housing, care. We know so many people are both carers and also employees of your business, so real focus around that. And really the impact that the pandemic, cost of living, now increased interest rates, is having on employees across the country. It impacts people in different ways, and so as employers, there really needs to be a personalised approach to what can you do and what can you offer to make it as personalised as possible to then enable people to access it. It's also a real balance. So as I mentioned, we in the past have had a very reactive approach to financial wellbeing. We're now moving to a much more proactive approach, and for me it's a real balance between empowerment and paternalism. Actually, what can you do to create the environment where your employees can access things? What can you do around nudges to action, and providing the mechanisms and the environment where people can take their own decisions, but know that they're supported in doing that. So whether that's providing information, tools, doing that in the best way. Often, financial wellbeing isn't something that people really want to focus in on. So actually, what can you do to ease them into doing that, make it a smaller step, and then really creating an environment to talk. So within our holistic wellbeing model, we have an EAP, which is actually internal, so it's partners providing support to partners. So through cost of living, we provided additional training to our team and really publicised how our partners can call that line and talk about anything which is impacting them. So not just emotional support, the practical support, and creating that environment where people can speak confidentially about how they're feeling, how it's impacting them, and what we do as part of that conversation by using a coach and grow model is help them to form an action plan. So actually we're not taking responsibility for the situation, but it's what can we do to enable and empower them to take the decisions and form that action plan and then deliver on that action plan. So our interactions with our partners, they will call us, we will, with their consent, record some of the key points from that conversation, but giving them the avenue to then come back and talk to us about how they've progressed that. And so someone may call us 2 or 3 times, but then we can monitor how their progression goes. Because actually, for me, I really want us to provide that support to our partners, but I also want to find a way that we can measure the impacts around it. So actually, not just about individual actions, but really drive that behavioural change for our partners. And then the third one for me, linking in, is just really empowerment. So actually, how can you help your employees to access that support, reduce the stigma, or get rid of it at all? We know that within the UK, certainly historically, people didn't want to talk about money, and particularly they didn't want to talk to their employer about it. What we try to do within the partnership is really drive that so that they know it's confidential, they know that actually no one will know they've contacted us, but really try and break that stigma with our communication and how we drive activity forward, just so that we can have as many interactions as possible with our partners. And then it's around how we drive that awareness. So we have tried lots of different ways, as I'm sure others in the room have too. And for me, there's no one way to do this. It is about providing information in mediums and where and when your employees really want it. So when we do our strategies and when we're driving that awareness, we have to do it in 6 or 7 different ways. We're a 24/7 operation, so if we're doing a webinar, we have to record it and then make it available. But that also, I think, allows the longevity of things that you do, and also means that actually you can do quite a lot without there being a significant cost. So the cost isn't a reason for not doing things. And then also helping people engage, so actually trying to start a conversation in your business unit so that actually one person will tell another person what they've done, and trying to build a bit of a volume and really a space around that. And then it is just providing that support, so providing that avenue for people to talk. EAPs are so important, but so underutilised. You know, the standard usage of an EAP is between 2 and 4% of your employees. Drive that forward, make sure that your EAP is providing the service that you're paying for. We find actually having an internal EAP has really driven the trust that partners have. The fact that it is a partner that they're speaking to, partners supporting partners, really works through in terms of that model. And then finally, retention. It's not, we do what we do for our partners because it's the right thing to do, but it's also really commercial. And retention is one of the largest costs to most businesses. It also is a massive impact in the productivity issues that businesses face. For me, this space around financial well-being, if you can create that emotional relationship between your employees and their employer, really pointing out that what's happening outside of work impacts you in work. We care about you, therefore we want to support you in it. Really driving that forward. Supporting people at all life stages. So actually, everyone's different. We have between probably 4 and 5 generations working within the partnership right now. So we need to ensure that we have things available for every single one of our partners to really make it personal. And then finally, just really the focus and the impact on broader well-being. If something's happening in someone's finances, they won't be sleeping, they'll have higher levels of anxiety, and really for me, that is the real linchpin within well-being. So I'll finish there and really want to open it for the maximum amount of time to have questions. But thank you, and happy to talk to anyone later on today about what we've done. We don't have all the answers, so I'm really keen to get answers from others in the room too, but thank you.
Brilliant. Well, thank you so much to all 3 of you. I thought that was a great, quite varied trip through the different kinds of things that employers are doing or could be doing. Everything from a free lunch to some of these more sophisticated products like earned wage access. What I wanted to start to try and tease out really is a sense of where the debate is now among employers. It's very clear, it sounds from your chart, that there's a big diversity of opinion about some of this, and Matt, you talked about this tension between empowerment and paternalism, and I wonder if we could talk about where are the areas in which there's some consensus sort of building, and where are the areas where actually there's still quite a lot of disagreement really about what's the right thing, or which things might sound like a good idea but actually could be a bit dangerous either for the employee or the employer. Shope, do you want to kind of kick off on that?
Sure. I'll make a start and colleagues can join in. So when we spoke to employers, one of the things that we found was there wasn't consensus, right? So you'd speak to one employer and there'd be the sense that it's our obligation, or we see it as our role to make sure that our employees are financially well. And then on the other hand, well, if people can't budget, that's their problem. If people can't sort of plan for the next month, that's their problem. So I think that is very much the point of contention. What is the role of the employer? What is your obligation? And I think for those that are sort of in a middle ground, I think they would really agree with a lot of what Matt said and with a lot of what Sam said around the opportunities and the possibilities, but they haven't really understood the return on investment for those things. So while they might make sense from a gut point of view, or because you do genuinely care for your employees, the sense is that it's harder to make the business case, and it's therefore harder to sort of drive forward specific solutions without really knowing actually what is the impact here and what's the return on investment for us as employers. But I welcome other views on that as well.
Yeah, what do you think, Sam?
So I still feel that earned wage access is quite new, and not everyone has really wrapped their head around it yet. And it's a bit of a marmite. People either love it or they hate it.
Do you mean from the employer side?
From the employer's side, and from payroll professionals as to where that fits into their responsibility. And it goes back to, well, if you can't budget, it's your problem. Why should I have to step in? Equally, the CIPP stance is, it's great. It's an avenue of opportunity, but it should be built into a wider financial education package. So yes, okay, I need to borrow £50 because my child needs new school shoes, because they get trashed so easily, even when you buy them from Clark's. It drives me mad. But payday comes, I'm £50 down, I can't make my mobile phone repayment. That's not an education. By giving the money, it's a quick fix.
And potentially you can get into a cycle, presumably, of needing to do that then every month to kind of keep
potentially
bridging things.
Potentially. And that is the apprehension from employers. They don't want to implement something that could cause more financial detriment. But it goes back to this lack of understanding as to how models work and that wraparound. So that's kind of my food for thought on that one.
Yeah, I'd probably add to that, and for me, it's not one thing or another. So for me, earned wage access isn't a replacement for budgeting. I think it's giving that freedom and choice to employees. So earned wage access could be used because something has happened that someone wasn't expecting. I think the other side of that, and I think where potentially businesses could harness this, is actually around the flexibility that they really want from their employees, but also giving that flexibility to their employees. So actually, if I kind of go into the mists of time when I was young, if I potentially was wanted to go out at the weekend but hadn't got the money to do it, and actually my employer said on the Thursday, oh, could you do an additional shift? If I can get that money sooner, it's a greater reason to do it. So I think there's, just for me, I think the technology is there, so actually use it in the best way and in the way that works for your business. So we went live in February with salary finance. We thought a lot before doing it, but have really kind of looked at what we can do to bring their offer into what we already do.
So that's an earned wage access program,
yes,
is it?
yes.
Yeah.
Yes, so our partners can access up to 20% of their earned income before payday.
And have you tracked how it's going? Is there a sense that employees are using it?
Yeah, so I mean, usage has been perhaps lower than I would have expected it to be, but it's something that we monitor, and it very much is there as it's one of the tools which is available to our partners. So actually it isn't something that we really push, but it's actually just creates that environment of empowering people to use what they want to within a broader benefits and wellbeing package.
I suppose in a way maybe it's reassuring it's not being used too much, suggest you're paying people enough in the first place.
Can I just add something else as well? I know we're talking about low to moderate earners, but I know from earned wage access kind of conversations, and there's a lot delivered at conferences that I attend, actually higher earners are also using it, and their thoughts on that are, well, if that's my money that I've earned, why should that be sat in my employer's bank account? It could be sat in mine, and I could move it to a savings fund where I'm earning interest, albeit we know that savings interests aren't that great. It's all in the news this morning, isn't it? But it's not just for low to moderate earners. Everyone is using it. But it goes back to that awareness piece. You know, you toyed around with, do you implement it? Then do you think the take-up hasn't been that great because employees are also unaware of how it works?
Yeah, I mean, most businesses in the room will probably say actually driving awareness of what you have is one of the biggest challenges. You know, with turnover, it isn't a kind of one, you can have one campaign and everyone knows. It's about how you drive that forward, and I think for me, where I mentioned around the emotional relationship between businesses and their employees, actually really demonstrating all of the things that are available in terms of benefits, in terms of wellbeing offers, etc., actually I think helps to build that, and actually can really, though pay is very important, it is just one element of what employers can offer their employees.
Yeah, I was struck by your comment about that emotional relationship, and I wonder whether, you know, this moment that we're in now with high inflation, people going through another bout of, you know, a fall in real wages, I wonder how that relationship is changing, and whether for employers, I mean, for some employers this has become a relationship of real tension, right? Because clearly employees are asking for higher wages to match inflation. Not all employers are willing or able to do that. But then presumably it also opens a window of opportunity to try and say, look, you know, we're going to try and get through this together. You know, one of the areas, what feels like consensus from what you're saying, is that whatever product or products you kind of offer to people, it needs to be part of this wider sort of package of financial well-being. What would that look like in an ideal world? What are the kind of key elements of what that would be?
Well, there will be a huge number of views on that. I mean, I think a starting point is often just like looking at the state of things. So we know, for example, that nearly 4.5 million low income or nearly 4.5 million low to moderate income households took on additional debt or new debt during the pandemic, and that for many of those households that debt has followed them and become problem debt post-pandemic. So there's a very sort of real need here, and those households will be clustered in sectors with sort of lower pay or variable pay. So I think there's an opportunity here for employers in those sectors to sort of look at the whole of the person, right? So what happens when you have problem debt? Well, that, as Matt was saying, there will be mental health effects, there will be productivity effects, your ability to save in the long and short term will be affected. So I think when we introduced the 6 financial footings, those felt like entry points. So they don't necessarily tell you exactly what the solution is for, you know, handling a shock such as an illness versus planning for the school shoes, which you know is coming and you know will cost you a certain amount, but always seems to be a bit of a shock every time it happens. But I think there is something around a package that looks at the whole of those financial footings and says, okay, well, what makes sense with the needs that our employees have if they've taken on problem debt? Is there something we can do that's specifically around consolidating that debt, for example, or is there something we can do about giving them alternatives, like we showed on the tube map, that they will have other alternatives if the employer doesn't step up. So what sort of good pathways can we put people onto? So it's less of a sort of this is the exact product answer, but kind of when we think about the products, these are the types of needs they should be aiming to address.
I guess the you know, I can really imagine that if you have some problem debt and the interest rate is high, or you're being chased, it could be incredibly stressful. And actually an employer who says, look, we'll consolidate it, you know, get all of these people off your back, and, you know, there'll be a lower interest rate, could be a huge relief. But I wonder if the problem then, or the question then, is about the relationship of trust between the employee and the employer, to be able to even let them know that they're in that situation, because it kind of, you know, not everyone might necessarily feel confident to talk to their employer about what's going on in their sort of private financial lives. Do you have any thoughts on sort of how that can be tackled?
I guess it's pushing employee assistance programs, so it's removing that, going to your line manager, you know, becoming extremely vulnerable because your line manager may have their own perceptions of financial difficulty, and that may not be aligned to the company that they work within. So again, it all goes back to awareness, doesn't it? It's pushing that, making sure people know it's available. So, you know, do you harp on about it in every single newsletter that you push out to your employees? Do you include it on a payslip message? Do people look at payslips? Who knows? You know, and going back to your previous question, and again, what I said when I stood earlier, there's no right or wrong, and you know, you could put 3 employers in a line and ask what you provide, and everyone would come up with a different answer because it's based on employee needs. We spoke earlier about, you know, maybe these solutions, so loans, these consolidated loans, don't necessarily need to be provided all year round. They're given on an ad hoc basis as and when someone comes to you. But again, you need to ensure that people know that they can come to you and that option's available. So it will depend business to business.
Yeah, the other question I had was around the providers, you know, the third-party providers of some of these different offerings, whether it's earned wage access or different sorts of loans or products, EAPs. I wonder what that does to the we've been talking about this relationship as if it's a two-way relationship, right, between the employee and the employer, but actually that kind of adds a third, then you kind of get a triangular relationship, and I wonder how that's playing out so far in terms of who's driving the discussion in that relationship. Is it really the providers of the products who are determining how they work, or is there a bigger role for the employer or indeed the employee to shape how it's playing out?
For me, it definitely is a circular element. So it's when you're looking at third parties, it's what's the issue you're trying to solve, and then looking at market, what's available, working with that, and you know, some of that will come from what you're hearing from your employees, then actually working with the supplier to provide the product or the service that you really want, ensuring then you get the data coming back from that of usage. A lot of that can be shared without going into the personal nature of things, and then just for me it's just around continually reviewing but working closely with the providers to adapt the products to the circumstances which you're in. So I think for me and our experience is really close relationships with our providers and the opportunity to try new things, and actually you know, looking at, you know, what can you try, what can you do, how can you get greater awareness but also greater usage of the tools.
Can I come in?
Yeah.
I think as a researcher, I love that you've described this beautiful data-driven process. But what we found in some of our discussions was that not all employers have that ability or kind of the resource in-house to understand exactly what's going on with their employees. So that side of the data circle is somewhat broken. And for smaller employers as well, they don't always know what the difference is between a provider who's a credit union versus a corporate offer, and don't have the bandwidth necessarily to sort of complete that side of the circle as well. So I think whether it's a circle or a triangle or whichever geometry we're looking at, there is an opportunity for especially smaller employers to have tools that allow them to sort of look at the suite of options and feel like they can shape the market as well, and that that would be based on information that they're getting from their employees about their financial well-being, not just on a hunch or a guess. And there will be cases where there isn't a provider in the picture, so I go back to your butcher example where he has real-time information about what's going on with his employees because there are only 3 of them and he probably knows them quite well. And there are smaller things, as you were saying, that he could do you know, day to day. So that triangle feels like there are opportunities to make the connections between the points a bit better.
Excellent. Sam, did you have any thoughts on that?
Yeah, in an ideal world, you can get that data and you can have those conversations with your employees easily. And it's the old chestnut, your customer's always right. So you need to ensure what you're providing is what your employees want. If we put that into context for earned wage access, do they want that money in their bank account? Do they want it on a preloaded card? It will depend what their financial circumstances are as to whether they need to go out to purchase things, or maybe they just want to be clearing a credit card and they'd rather have that money in their bank account. So it's a difficult one, and yes, we know that you can't always get the data from employees, but let's pretend that employees are open and honest and tell you what they want.
Well, that brings me to my next question, really, which is about what, clearly this is an area of huge interest for employers and of huge importance for employees. But to some extent, we're still sort of slightly in the dark on some of these things, and I wonder what information you wish you knew, and what you would do with that information, and how you would act on it if you had it. I mean, what kind of data or other kinds of information do you think that at the minute we're lacking, but that if we had, it would help us in this, to kind of move this forward in a helpful way? Matt, you're looking thoughtful.
Yeah, just letting the thoughts actually come through. I think it for me, the current battle is around how we drive awareness and usage, and so almost knowing what we could do for specific groups of partners. I think that's the because we've got a great offer, but unless people are using it, we're not making that change and making the most of what we have.
Yeah, if I take a kind of payroll stance on this, it would be reminding employers what they could do without giving rise to benefits in kind, that doesn't cost them lots. We're very mindful of the employer from the CIPP and what they can do without costing the earth. So it would be reminding employers what they can do to help their employees.
I think for me it would be around impact, and I think understanding the impact of not just earned wage access and not just different loans models, but the interaction of those different offers with existing financial well-being benefits would then speak to some of the things that you both have said you wish you had more information about. So we know roughly sort of amounts that people are accessing early. We know roughly how people are accessing loans, but we don't really get a full picture of the impact that that's having on their broader financial well-being, what financial behaviors that might be incentivizing or disincentivizing. So really understanding the impact more so that we could feed that back to colleagues who are working directly with employees, I think would be what we would want to know.
Great. Okay. What do you guys want to know? You're all been very patiently waiting for quite a while. So I can see there are already lots of hands up, which is brilliant, my kind of audience. So maybe, seeing as it looks like there's plenty, we could take the questions in groups of 3. So someone will come around with a microphone. If when you start you just say your name and where you're from, that would be great.
Thanks very much for a really interesting panel session. I'd just be interested in the interactions between what we've been discussing here and auto-enrolment, whether there's experience of employees, partners coming to you and saying, look, I really want to opt out for a period because my financial circumstances are so acute, and how comfortable or otherwise employers are in sort of discussing the implications of that with employees.
And where are you from, sorry?
Sorry, John Parker from Reddington.
Super.
Rennie Biggins from Tizer. Do you find that employers' views and sentiment are influenced by sector and size? And also, have you seen any sort of changes, notable changes in trends, particularly over the last sort of 3 years?
Great question, thank you. And there's a gentleman over here.
Hi, I'm Nathan Lowell from Hargreaves Lansdown. I snuck in a bit late, so if you've covered this, please feel free to just tell me to shut up. I'm just really interested in how you perceive the trade-off between a nice-to-have product around loans, for example, around forwarding sort of advancements of pay to help with problem debt, and actually what role employers should have in just solving the issue at source. And the reason I ask this is because we've done a lot of work on financial resilience, and in our conversations with Step Change, the debt charity, they've said that one of the key catalysts for people getting into problem debt is when their employer cocks up the payroll. And I just find that completely unforgivable. So we're doing work in the local Bristol area, and that's resolving payroll errors within a week is one of the stipulations that we've made on employers that we're working with in that area. So I guess the difference between great products and let's just whip the employers up into shape, if that makes sense.
Okay, those were 3 excellent questions. What's the interaction with auto-enrolment? What's the kind of range by sector and size, and what sort of trends have you seen in the last 3 years? And then finally, Nathan's question on, what about just getting employers to not mess up the payroll and not create problems in the first place, which is a good one. So, who wants to take any or all of those first?
I don't mind kicking off.
Great.
Okay, so employee opt-out rates for auto-enrolment. I haven't got my phone on me, but the CIPP did a quick poll to ask employers whether they saw a higher opt-out rate as an impact of the cost of living crisis. I think it was around 33% of people were opting out, specifically stating that that was due to the cost of living crisis. But please grab me while I've got a coffee in my hand after this, and I will share those stats with you, and I can share the stats on a wider scale as well. Did you want to talk about opt-outs, or shall I continue with all? Okay, go. So sector and size then, in regards to whether that kind of, a smaller employer should be looking at financial well-being. I don't have stats on that. I'm sure we can pull it together from the reports that we've ran and from the surveys that we've ran. But my gut feel, and that is all I can comment on, is that smaller employers would say it's not their responsibility, whereas larger employers will say that it's their responsibility because they've got the resource and the finances behind them to put things in place. And then our third question, one, you're absolutely right, it's unforgivable if payroll are cocking up, in your words, and they should be putting it right. Sometimes there will be, external impacts. There's been a lot on cybersecurity hacks within the payroll industry at the moment. That is taken out of a payroll department's hands. In regards to this trade-off, is, I'm an employer and I can say that I offer earned wage access. That's great. Should you be just fixing it at source? Yes, but how much information will employees want to share with their employers in regards to budgeting, for example? Do I want to turn to my employer and say, I've got debt here, I've got a car loan here? There's a battle there as to what's right and wrong. Again, it's this bigger picture. Could you give someone an Excel spreadsheet to help them budget? Yes. Could you sit down with someone and say, tell me all your debt? Probably not. So there's workarounds. But yeah, payroll shouldn't be getting things wrong. Normally, if it is or it has gone wrong, it's normally a lack of data being sent through. So for example, someone's really reliant on their overtime so they can go out next month. If the payroll team don't get that overtime information on time for the next payroll run, there's an issue. Again, it all links back to awareness. Yes.
I'd probably say on the second question, even we have 74,000 partners, but actually almost to take it down to between different sites and different areas of our business, the way people engage with the information and what they want is very different. So I think that that's probably the thing there. And I'd probably say on smaller employers, I think there is an opportunity there around, often within smaller employers, it's a much more personal relationship. So I think there are real opportunities there in, the butcher, and not necessarily do it from a, how do you spend your money, but actually just ensuring they know what's available to what's bothering them right now. We signpost to Money Helper. It's a brilliant resource. If you think, the budgeting tool on there, I would suggest, regardless of whether it's something you're raising to your employees, it's a brilliant tool for anyone to use. It's really simple to use, and I think for me, financial well-being, the word budgeting, but it's actually thinking by making the most of the money you have, you can do more of the things you want to do. So it's an enabler, not something that someone I don't want to do, or it'll stop me doing the things I want to do. Actually, it can enable you to do more of the things you want to do.
Sure. So coming in again on that second question about the size of the employer and sectors, I could get you some figures during lunchtime if you're interested. And I think I would largely agree with what has been said, but to say that it's not a hard and fast rule that a small employer would necessarily not be interested in looking at what they could do for employees' financial well-being, or that a large employer would necessarily, again, understand the return on investment and make the scale of contributions or the scale of offer that you might expect given the resource they have available. In terms of sector, I think employers that are in sectors that are high churn, so hospitality, for example, would be less likely potentially to offer a loan, because what happens if that employer or that employee leaves before the term of the loan is ended, and concerns about the kind of administrative burdens around that. Of course, if you're using a third-party provider, that can be addressed, but might still be a concern about having sort of the risk of debt sort of scattered about if someone joins the organization and leaves after a short amount of time. And then on the question about the trade-offs, I would say, in addition to what has been said, that earned wage access solutions in particular do sort of link with some of the ability of employees to view their pay more transparently. So there is almost an accountability piece here, where if you're solving the problem at the root, and all that is, the payroll colleagues are doing everything within their powers to make sure that pay goes out on time and accurately, that actually some of the solutions on the market available actually give people the ability to see that and sort of hold their employers accountable as well. So it's not necessarily an either or when thinking about how those things can work alongside each other.
Yeah, I would just endorse your point a little bit. As a reporter, I spend a lot of time talking to workers at the kind of bottom end of the labour market, and it is extraordinary how often payroll errors or just not being paid for the right shifts is a problem for people, and it's particularly for agency workers, where it's almost a kind of monthly occurrence that your pay is not what it should have been for the hours that you did. And I think it does link a bit to one of the things you had, Shopi, in your presentation, that actually one of the drivers of financial stability or instability is your income really unpredictable? And there has been interesting work on how incredibly volatile a lot of people's income is from month to month, particularly at lower pay, and how hard that is to cope with. Super, let's have some more questions. Brilliant. So we'll take another 3. There's a woman here, there's a girl here, and we'll do 3 women, and then a woman here. After 3 men.
Hi, I'm Anna from Pay Captain. We're a modern payroll solution. We don't make errors. I'm really interested in this role around trust, because you can have a hugely inclusive offering that's really appropriately easy to access, but depending on what it is, build all that awareness. But if you haven't got the trust piece in place, people just aren't going to engage with it. So, Shopi, Matt, Sam, what have you seen through your conversations and internally in your business, where you've seen really great ideas of people being able to build that trust with their employees?
Thank you.
So this is a question coming from the Slido. There are lots here if we have time for them.
Okay.
But the one that's most popular at the moment is thinking about different groups of employees, and we've talked a bit about variable pay and shift work and all the variety that exists within an employee population. How can employers sensibly prioritise how they choose which employee benefits to invest in? So I think behind that is, if there's a constraint, where do you go first?
Yeah, okay, very good. And
Hello, I'm Sally Bridgeland. I'm a former Nest trustee member, but I'm now a director, non-executive director of a number of companies and local pensions partnership in the public sector, and Royal London, who does workplace pensions in the insured sector. And looking at that whole ecosystem, there's an awful lot of stuff on insurance companies at the moment about consumer duty, vulnerable customers. We're all looking at the same stuff and all trying to do the same things in terms of improving the financial health of customers or employees. So my question is how could other people do things to make your life easier so that we're not reinventing wheels? What's the role of the press? What's the role of government? What's the role of the money service or the organisations out there that could make life easier or actually more effective, especially playing to the earlier question about trust, in that this is really sensitive information that people want to reveal, and they want to have the confidence and the trust that the person who they're giving it to is treating it with respect. But equally, we want to help them out.
Super. 3 more very good questions. Who wants to take 1, 2 or 3 of them? As many as you want.
I don't mind kicking off. So on the first one around trust, it is, we as a co-owned business kind of really use our wellbeing offer as a way to connect our partners to our business. We this week, Partnership Week, us being us, to make it feel special, because it is. So I appreciate, we perhaps have a personal way in which we could do that. But I think as I said in my short piece, for me, it is about your employer providing greater support, and things not just being there for the sake of it, but actually, personally, it probably links into the second question in terms of what to invest in. It seems a really simple thing, but businesses talking to their employees about what's really important to them and not presuming to know what that is. So I think that's really important. I think probably in terms of what others can do to help is, at times, personal view, taking some of the heat out of things. The times last year where it felt as though every single news bulletin started with cost of living, and if people, and it was and is an issue for people, but if you weren't thinking it was an issue when you turned the news on, you certainly were at the end of it. And I think cost of living is breaking things down into what actual practical things can you do to make things a bit better. And I think that's what we try to do within our wellbeing offer. There are many tools available, but actually, what are the practical things you can do today? What are the things you can do tomorrow? What are the things you can do the day after? Because actually, often you can't solve things by doing one thing. Because actually, if there was a silver bullet, we'd all be doing it.
Super. Sam, should we?
I agree with everything you've said. I don't think there is much more. Everything we've spoken about is communication with employees, isn't it? How do you build the trust? It's asking them, what's up? What's up? What can we do to support you? How do you prioritise? Great question. Again, it's going to be dependent on what your employees want. Nothing else to add.
Those are all such great questions. So I think one thing we found was that levels of trust were not actually especially low. People would often say to us, I'd rather get a loan from my employer who I know is not making money off of me than from a payday loan or even a high street bank loan, because someone is making a profit off of the fact that I've come up short this month, and actually that doesn't feel great, but I know my employer won't be doing that. So I think there's maybe a foundation that can be built on by doing exactly the things that you talked about in terms of communicating clearly. I think you can also build trust by getting it right. So we talked about the things that employees needed around avoiding risk, so avoiding that high interest rate that risks default, being cost effective, being timely, being flexible, being discreet where they need it. I think if you can sort of reflect not just what do you need in terms of do you need lunch or do you need a loan, do you need but sort of getting it right by ticking some of those boxes, that goes a long way to getting it right. In terms of what else, earned wage access and loans in particular are I think someone used the word marmite earlier to describe them, but they're also not entirely well understood in regulatory context. So sometimes earned wage access gets conflated with a debt solution, and loans just seem confusing because my employer is not a sort of FCA regulated entity. And so some regulatory clarity there, I think, would go a long way towards helping employers decide, okay, here's what we're able and willing to do, here's the risks involved with it, here's where we're covered, here are legal obligations, and then therefore it sort of demystifies some of the things that feel quite risky or sort of not as compelling as solutions like, that are more traditional or better understood. So that's something I think could be added as well.
Great, good, tangible answers. What's the time? We've got time for a little bit more, probably another 3. There's more than 3. We could maybe go on another 5 minutes if you don't mind a slightly shorter lunch. So we will take this gentleman here. Who else had their hand up? Yes, and these two. And then after that, we'll do quite short answers to those. We're going to take the final ones, and then we'll break.
Yeah, thank you again for a great discussion. Callum McCaig here from a company called WageStream. 20% of people who go to the gym every year injure themselves in the gym. Under 5% of people who use a loan or earned wage access at work get into financial difficulty, and 90% of them say it helps them. So why have I heard the idea of choosing when you get paid or getting finally access to a fair loan described as marmite today, and why don't I hear the idea of sending employees to rooms filled with death trap machines as a marmite idea? It's about paternalism, which you mentioned at the start. I'd love to hear a bit more about your thoughts on it.
I would argue that gyms are definitely marmites, in my opinion. Okay, yes, this gentleman here.
Hi, Charles Cotton from the CIPD. I could take all the information in my organisation with the HR data. I could take all the information from the benefit providers and all the other information. I could then work out, using AI, which of our staff are most at risk of falling into financial distress, and having conversations with them. Now, is that ethical to actually use that, or is it unethical to let people fall into financial distress when you've got the tools that can help them?
Very good question, thank you.
Vaughan Jenkins from Money Hub. It's a little bit of a segue from that question. So Money Hub provides the financial wellbeing app behind Aon, Mercer and Standard Life's Money Matters in workplace environments. And we've been looking at just how much control we can put in the hands of the actual employee rather than this, if you like, helicopter employer view. And we've been currently doing something like £800 of savings a year for employees simply by making them realise that they've got those employee benefits already, like retail discounts. Even more when we start nudging them away from missing payment dates, missing the fact that they're going to go into overdrafts and subscriptions from COVID that they're still languishing in their current accounts and so on. And it just seems that there's so much data there that's available through open banking that doesn't necessarily need, as I say, this kind of helicopter view from the employer. It's more about actually putting it into the hands of the employee. I just wondered if organisations ought to be using that more.
Very interesting, thank you. I tell you what, let's take the other. I think there was another 2 burning ones, wasn't there? And then we'll do answers to all of them and wrap up. Is that okay? I think who was it over here who had their hand up? Yeah. So we'll take this and one more from Slido.
Firstly, thank you for the talk. My name is Taha Weeks. I work for Schroders. If you had one question to the next government, one policy that you wanted to implement to the next government to do what we're saying here around getting the corporates more involved in financial well-being, what would it be?
Good, short question, I like it. And yes, one more from Slido.
So from Slido, the 33% of employers in Sam's chart who are unsure about whether to assist employees' financial well-being seems an opportunity. Do they need to better understand the business case? There's also a question in there about, do we know what it does for retention? So what's the thing that might sway the people who are on the fence?
Okay, brilliant. I would invite you to take your pick out of all of these excellent questions. Don't feel that you all need to answer all of them, but yeah, whichever ones you think you have something to say on. Shope, do you want to pick up?
Speak to the Marmite gym
Yes.
metaphor. So I think a couple of reasons you're hearing the word Marmite is that earned wage access is not especially well understood. I think that will change with time as your organization and others sort of raise awareness, do more research, as Nest Insight also does more research alongside other organizations. But I think there is just a question mark about what is the real impact. It seems like a good idea, but I can more quickly think of the things that might go wrong as part of that. You also are hearing that it's Marmite because we heard from employees that not every use case is a good use case. So we sort of did a good use, bad use exercise with folks and heard that there are things that actually, very similar to actually what Matt was saying about, actually if I can pick up an extra shift, I'd rather do that than draw down on my wages early, or if I can do other things, there are things I would rather do. So that's where the Marmite comes in, and I think it's in and amongst other options, right? It's not just sort of there's earned wage access and there's nothing else, and if you don't like Marmite, you'll starve sort of situation, that it's exactly what we've been talking about, having it within a comprehensive offer that maybe changes how people feel based on the options they have. But we've heard from both employers and employees that there are good uses and less good uses, and therefore Marmite.
Great. Anyone else want to come in on it?
Yeah, so two really quick responses. So to Callum's question, what I would say is I don't think it's paternalistic for businesses to provide tools which their employees can then access. If by not providing them doesn't necessarily mean the issue isn't there. And recently I had a really almost terrifying stat that 20% of people meet a loan shark at work. So if they access a loan shark, they have met that person. It is one of their colleagues. And then just on the elements around, so the partnership is an apolitical business. So I do need to say that, but our personal view would be a future government providing incentives for businesses to invest in these areas, because actually they want to do it, but it's actually finding the way to do it and encouraging them to do so.
Sam?
Yeah. The Marmite, sorry, I was the one that said that in the first instance, but it's because it's new. Like anything, like how auto-enrolment would have been Marmite way back when. You know, it's just one of those things. Charles, in regards to using this data, whether we should be proactive versus reactive, I suppose. Does it go down to, do you just ask individuals? I've got all this data. We're wanting to draw up a financial well-being strategy. Are you good with us using this? Is it, you know, it could be as simple as that. Retail discounts, absolutely. It's that broader spectrum of offerings that I spoke about earlier. Policy to next government, great question. Yeah, love that. It's allowing and enabling employers to be able to put these things into place. Also, I know at the previous Nest event that we were at, I spoke about Help to Save reform consultation that was coming out, mandating sidecar savings potentially, you know, quick win in this room anyway. And then the 33% of people who are unsure, yeah, at 100% it's a huge opportunity to upskill and raise awareness.
Could I come back in on
just
Vaughn's point about there are tools in open banking solutions that sort of give offers that might make sense more than an employer taking a role. And I think part of the underlying assumptions that we've been working with and that data bears out is that low to moderate income workers are less likely to seek out those kinds of solutions. So I think your average Money Hub user might not be a person who experiences the same type of financial volatility, income volatility, or variable pay, who may not have the same concerns around debt or saving, and whose financial footings are essentially more secure. We just know that people are less likely to have the kinds of options that higher earners have. So if there's a sort of way that employers can become an intermediary and again point to solutions and point to tools that support people to manage their finances better, that absolutely makes sense. But I think our thinking at the moment is that in the first instance, the folks that we're discussing today might be less likely to seek out those solutions in the first place. So there is a role for the employer as an intermediary, and as has been said, to sort of point to solutions and offers.
Okay, well, on that note, I think that wraps things up quite nicely. Thank you so much to all three of you. I found that really fascinating, and I hope you all did too. And as a final note, I hope you appreciate how well we coordinated our outfits today, just for you. So please give everyone please give the panel a round of applause. Thank you.
Just a very quick follow-up. So it's now lunchtime, so there should be lunch for you next door. We're going to start back, because we have to be on time for the live stream, we're going to start back on time at 1:10 so we'll start encouraging you through probably around 1 o'clock or 1:05. But please, in the meantime, have some lunch, chat to some of the people who you've heard talk or who you'd like to catch up with, and we'll see you back shortly. Thank you.
Pleasure. It's reached. Great. Did you feel like that fit the bill of what you wanted to get across?
Yeah, I think so. I mean, yeah, it was hard to know, like, more than welcome anytime.
Everyone. Yeah, you know.
Yeah, absolutely. Let me get this. Yeah, it's that whole thing.
I try not to turn my whole body, yeah, I think and I'm so sad at the beach, and I'm such blind to my right eye now.
everyone. Welcome back, and hopefully welcome back to people online as well. So welcome back to our session on how changing patterns of home ownership, what that means for retirement systems. So I'm Karen Barker. I'm Head of Policy and Research at Aberdeen Financial Fairness Trust. We are a grant maker who funds policy research and campaigning to improve living standards for people on low to middle incomes in the UK. So within that, pensions are a particular area of interest for us, and in that we've partnered with Nest Insight previously on their excellent work last year on supporting employers to do more to support employee retirement savings, and we're currently partnered with the IFS for the pension review, which hopefully most of the people in this room are aware of. If you're not, check it out. So very excited for this discussion today because this topic of changing trends in home ownership is definitely something that's coming up in the pension review that we'll be talking about. And I should also say I have a personal interest in this as a millennial renter sliding towards middle age. So I will try and be objective in my facilitation of the panel, but I must warn you that if anyone tells me I need to buy less avocado toast to afford a mortgage, you're going to get a very salty response from me. So you've all been warned. So I do think this conversation is very timely, not just for myself. We're obviously facing an acute crisis at the minute with raising interest costs, meaning that those with a mortgage are going to be paying more, and those who are renting potentially facing higher costs as that gets passed on from landlords as well. But I think a lot of what we're going to talk about in the panel today is some longer term trends that really do present long-term challenges to the retirement system as well. So we are seeing home ownership levels declining, and we need to grapple with what that means for people's priorities in terms of the trade-offs between saving for a pension or potentially saving for a home. The traditional model of retirement savings often assumes low or no housing costs in retirement. But many of the people who have been brought into retirement savings through auto-enrollment will be renting into retirement or paying off a mortgage. So that's something that we need to question moving forward. There are also interesting differences between the kind of financial well-being overall between people in different tenures that raises questions not just about living standards in retirement, but again, thinking about people's ability to save for a pension. So this weekend at the Trust, we're going to publish a briefing drawing on some data from our Financial Fairness Tracker, which is a large survey that tracks financial well-being in the UK, looking at financial well-being across different housing tenures. And I wanted to pull out a few of the stats that I thought were particularly interesting context for this conversation. So we found that nearly a quarter of households living in the private rental sector could be classed as in serious financial difficulties currently. And that compares to slightly more than 1 in 10 of those who have a mortgage, and only about 5% among people who own outright. So obviously very different levels of financial hardship across different tenures. And really shockingly, we've also found that among private renters, 1 in 12 in the past month haven't eaten for a whole day on 3 or more occasions because they couldn't afford food. And again, if we compare that to other tenures, so it's less than 1 in 20 of people with a mortgage who are in that position, and 1 in 50 who are in that position for people who own outright. So I think this speaks to the financial pressures, particularly that younger generations are facing, that aren't just about housing costs. Many younger generations will be paying off a student loan for much or all of their working life. And for those with children, we're grappling with some of the highest childcare costs in the OECD. So I think that gives a kind of holistic picture of a lot of financial pressures that mean that for a lot of the younger generations, they will be struggling either to access home ownership or to save for a pension. So on that slightly dire note, I am going to turn to the panel, but I promise it's not going to be all doom and gloom. We are going to talk about possible solutions as well as talking about the many challenges. So yeah, I think without further ado, I will pass to Paul Cullum from Frontier Economics to say a bit more about the context.
Thank you very much. I think I'm the doom and gloom part of the panel, and the other two will provide some solutions in a moment. Afternoon, everyone. Yeah, Paul Cullum from Frontier Economics. I think as Karen recognised, we're holding this panel at a time of potentially quite massive disruption to the housing market, having a few interesting conversations outside about monetary transmission in the mortgage market, which is fascinating, but we'll try and steer away from that, some of the longer term issues relevant for the panel today. What I want to do then for a few minutes then is to expand a bit on the kind of context that Karen was starting to set out a moment ago, which hopefully help us think about what the size of the challenge is in terms of home ownership and what that means for savings adequacy for the population. So let me start here, hopefully. Let me start there. For those on medium and high incomes, so outside of the social rented sector, which is a whole topic we might want to come back to, home ownership has always been a pretty reliable assumption for retirement planning in the UK. So back in the early noughties, only 1 in 20 of over 65 households were private renters, and that has largely been unchanged over the past 20 years. So it's always been a fairly safe assumption for retirement planning. But home ownership, as we talked about, is declining. And the trend is pretty substantial. I think back in the early noughties, actually all of the cohorts over at age 35 were in the same position as the retired population. So around 1 in 20, 1 in 14 of households were in private rental accommodation at all those age groups. And that has changed a lot over the last 20 years. So the proportion of those close to retirement, that 55 to 64 age groups now, 1 in 10 are still private renting. And in not wanting to judge too much, but Karen's age group, 35 to 44, 1 in 4 are currently in private rental accommodations. That's a real jump over the last 20 years. Now, the main driver of that increase in home ownership is, of course, that the price of housing has increased. The nationwide index shows that for first-time buyers, house prices have increased from 3.8 times the median income in 2003 to 6 times earnings in 2022. And that doesn't necessarily change mortgage affordability, as interest rates were, until quite recently, very low during that period. Obviously, that's one of the big changes that we're going through at the moment. But the amount of money being borrowed with higher house prices and therefore the risk that the bank and the household are exposed to is much larger. And so the amount that needs to be saved up for a deposit in relation to earnings has been much greater. And it is that additional saving that often delays home ownership, even if the person can afford a mortgage. They're largely paying rent at the time. There are many policy issues wrapped up in rising house prices, and we all love to discuss them. But the implication to reflect on today, I think, is then what happens if you do get to retirement without having paid off a mortgage. So let me give a simple illustration to bring that to life in terms of that savings adequacy question. So for a moderate income in retirement, a couple would need an income of about £34,000 a year based on the PLSA's retirement income standards, which requires about £13,000 to draw down per year after state pension. And that means saving up around, with my very simple modelling, so there's much better models out there today, but around about £300,000 to retire at age 68. So saving around £250 per month, even if you start at age 21. Now, suppose this couple doesn't get on the housing ladder, but they want to retire into this very nice and moderately sized 3-bed bungalow in Margate. Well, the monthly rent on this property is currently £1,400 per month. And that, of course, changes the calculation for how much you need to save up if you wanted to afford this as well at retirement. So to be able to afford both the rent and living costs of £34,000, the person would need to save up £720,000 by age 68, or £600 per month, more than double the amount they need to save if they also own a home at retirement. So a couple of implications of this, which I'm sure we'll start to get into. The first is that whether someone owns a home is perhaps the biggest single factor as to how much they should be saving. So if this couple needs to save £250 a month, and that is about 9% of median household income, but if it's £600 and they need to save to rent, that's 22% of median disposable income. The other major implication is the impact on overall financial well-being. So the chart here shows that on average over the working life, and again very simple calculations, the total monthly outgoings for both long-term savings for a moderate income and savings for housing costs in retirement, if required, and housing costs pre-retirement, so either mortgage or rent. So if someone is renting throughout their working life and not buying a house, that's on the left-hand side here, they need to save The total is £600, so the retirement income plus the rent for retirement, and they also need to afford the £1,400 on rent while they're working. So that's a total of £2,000 a month. For someone getting a mortgage, and in this calculation, someone at age 21, so very lucky, they need to save £250 per month for the retirement income, and then they need the mortgage. But usually the cost of a mortgage is lower than the cost of rent, because whilst rent will increase with inflation over your working life, the price that you buy the house at is fixed. So currently outdated assumptions, given mortgage rates and inflation are in a somewhat state of flux at the moment, with a difference of nearly £700 per month on average. So overall changing pattern of home ownership means that some people need very different guidance and defaults about how much they should be saving, which depend on where they are in terms of home ownership. And also that there is a potentially huge impact on financial well-being if people are able to get on the housing ladder, which in turn means a potential win-win if this industry can help to get people on the housing ladder in the short term, which in turn leads to higher overall savings adequacy in retirement in the long term. So before I hand over and we talk about less the doom and gloom and hopefully some solutions, maybe just a word on the current mortgage interest rate crisis. And I have to confess to using some assumptions that are from a very much a bygone era of about 18 months ago in these calculations, not wanting to pick or try and predict what's happening to interest rates or inflation. And we could have a whole discussion on that. But a couple of thoughts, I think, or one thought just to leave with is the distributional impact of the current shift we're seeing in interest rates. So, for example, many people approaching retirement may need to extend mortgage length or even switch to renting, which could mean more people needing to pay housing costs in retirement in the next 5, 10, 15 years, with big implications for savings adequacy. But there might be people joining the market in, say, 5 years' time who may find that house prices are much more affordable at that point and the size of deposits they need to save up or less, allowing them an potentially easy route onto the housing ladder. So could spend all day discussing those implications, but I think it all points to the interdependence between the requirements to save to avoid paying rent in retirement, whilst at the same time saving for income in retirement. So I shall hand over to the next panelist.
To Liz. Yes, thank you very much, Paul. And yeah, I think it's a really important point about not just potentially facing higher costs in retirement, but also just that if you're in the private rented sector, your housing costs may be higher than people with a mortgage. So for example, in our most recent tracker, we found of take-home pay for people in the private rented sector, they were spending on average about a third of their take-home pay compared to about 22% for people in owner occupation. So that's a pretty significant difference. And as you said, obviously with interest rates, that picture may be changing quite quickly, but we also know that there's generally, if owner occupiers are paying more, that often has a knock-on effect for rental prices as well. So anyway, yes, let's move on to hopefully slightly more upbeat. We've got Liz Fernando from Nest up next.
Thank you very much. I'm Elizabeth Fernando. I'm the Chief Investment Officer at Nest. So I'm going to try and be upbeat. I can't promise how upbeat I'm going to be. But the challenge I got from Will was if you can't afford to buy a house, how can investments help you? And get similar exposure to the housing market as you would have done had you owned your own house. So if you are an investment manager, the first thing you do when someone gives you a challenge like that is you go off and you look at your asset expected returns and volatilities, and you go and look for things which are highly correlated with the asset that you're being asked to replicate. So I went off and did that because that's what we do, and this data is drawn from JP Morgan's long-term capital market assumptions 2023 edition. If anyone wants to go and look them up yourself, they're online. And on the left-hand side, you've got correlations. So you probably won't be able to read the legend from there, but broadly, if you can't have UK property, and this is property as a whole, not just housing, it's very difficult to get return data for just the housing part of the property market. If you can't have UK property, European, US property isn't a bad alternative. It tends to be highly correlated. Interestingly, high yield, so what used to be euphemistically called junk bonds, they got a rebrand to high yield debt. That tends to be relatively highly correlated with house prices as well, or property prices. Interestingly, inflation, which is the second of the light blue bars in from the left, I had expected that to be much more correlated with house prices. It turns out it's actually incredibly low. It's about 0.2, which for anyone who's a statistician will tell you is not quite useless, but not far off. The darker bars are all the things which are negatively correlated with UK property. So you go through UK inflation-linked bonds, you go through world government bonds, gold, UK gilts. None of those things, those all correlate negatively with UK property prices. And the very worst thing is global timberland, which I put on there because it's something we're exploring, clearly not as a proxy for housing. Very long-lived asset, very stable, but clearly not good if you're trying to replicate property exposures. So that's interesting. I now know which assets tend to move in the same way as UK property prices. So then I went off, and this is the other good thing you do as a portfolio manager, you go off and you try and see, well, what's got a similar rate of return and similar volatility risk characteristics to the asset you're interested in. And that's the picture on the right-hand side. And it shows a not dissimilar picture, except the one thing I really wouldn't go and choose at this point is US property, because that's the blue dot down, much lower than all the others. Not entirely sure. It could possibly be US property prices are quite elevated at the moment, and that may be coming through in forward expected returns. But that clearly wouldn't be a great substitute for UK real estate, which is the area in red on the right. European real estate still looks like a pretty good alternative, and those high yield bonds, if you hedge the currency exposure, also not a bad shout. So that's an interesting challenge, and maybe we could get some, or an individual could get exposure by buying some of those things instead. I then had a look at this challenge of, if you're renting instead of owning your home in retirement, what does that mean in terms of your rising cost of rental over that retirement horizon? I apologise for the light colour of the inflation line in this slide. It might be a good thing it's light coloured, so you can't quite see how high it's got. But this, in the darker line, you've got UK private rental, housing, inflation, and the lighter line, as I say, is CPI. So they're not exactly correlated with each other, they don't exactly match, but you can see that, as has been suggested, the evidence does suggest that rental rates do increase over time. And that means when we're designing the retirement solution, we need to be thinking about delivering a rising real retirement income, whereas in the past perhaps we had been thinking much more about a flat retirement income because the assumption was that expenditure would fall over time. Now you may just about get away with delivering a flat nominal income in retirement and not pushing people into difficulty if you can assume that other sources of expenditure decline. So if you think people are going to be spending less on travelling, perhaps other leisure activities, then maybe the equation could still work with a flat income, but it'd be a damn sight more comfortable if we could deliver a rising income, a rising real income in retirement. At Nest, and this isn't an advert for Nest, we do take all of this kind of evidence very seriously, and we consider it when we're designing not only our accumulation phase investment solutions, but also the post-retirement solution that we have. And so that kind of information will influence the sorts of assets that we choose to buy in the post-retirement date fund. The final area I was going to talk about is, well, this is all great, but actually how can the asset owner industry help in this? And there are really three ways, I think, that asset owners can help with the housing challenge. The first and probably simplest is we shouldn't be competing. So we shouldn't be going out and buying existing stock of housing. That's just increasing demand in the market, and it's going to push up prices relative to if we weren't in the market. It's actually relatively recently that institutional owners have looked at residential housing as an investment. 10 years ago, it didn't really exist within portfolios. We had lots of property, but we tended not to stray into the residential area. That has changed a bit recently. The increase in multi-occupancy flats has increased the unit size that institutions can buy, and so there is now more institutional ownership of private rental accommodation. The second thing we could do is increase supply. So we could finance new build. We could give extra capital to perhaps to home builders so that they can increase their land banks and build at a faster rate. That would be another way that we could possibly help. We can't really, and it's not our business or our territory to get into planning rules, but clearly a relaxation of planning rules would help that growth of supply quite enormously. And then the third way we could help is by thinking about different models of ownership. So on the one hand, at the moment, we have home ownership, and on the other hand, we have rental. There is something in the middle called shared ownership, which does exist as a product in the market, still relatively small. But that's a model where you start off owning a small percentage of the property, and then over time, as you can afford it, you buy more of it. And so the balance shifts between being predominantly a renter at the beginning of the period and more towards being a homeowner at the end. And it's a way of staggering that capital costs that you need to stump up to get onto the housing ladder, and means that you can become an owner in proportion to your income at the time. So say it is a product that exists at the moment, but it is quite small and quite specialist, and it's perhaps something that the industry could expand and would be an interesting hybrid. The other potentially different solution would be to reconsider the whole model of home ownership at all. In many other markets, owning your home isn't the same thing, doesn't have the same prevalence as it does in the UK. Germany, for example, has a very large rental sector. The majority of people do rent rather than own their home. But that tends to be through renting through large corporations. The model in Singapore is really interesting because about 80% of people in Singapore live in government-built and owned real estate. And the third thing you do when you're a CIO or a portfolio manager and you get a question like the one I got from Will, is you go off and talk to your friends in the industry and you say, come on, I've been given this challenge, what would be a good way of answering it? And Singapore came back as an example I should use for you, because they have what is considered an incredibly well-functioning market. You can move properties, you can upgrade to a bigger property as you have more income. The housing stock apparently is incredibly well maintained, and people like living in government developed developments. So I guess if that model could take off here and we could encourage local authorities to build high quality housing and maintain it to high standards, one solution would be for institutional asset managers to provide financing to local authorities specifically for that activity. Lending to local authorities is something that asset owners already do, and so this would just be a natural expansion of that. So hopefully that has given a few alternatives as to how we could help as institutional managers. Thank you.
Thank you. I'm going to come to you in a minute, Damon, but Liz, I think I'm going to use Chair's prerogative to ask what is probably a stupid question, which is, so when you were speaking about the kind of relative returns from housing and from other types of investments, how much of that, looking at the return that you get from housing, is kind of reliant on the idea that housing values will continue to rise? Because obviously, you know, with investments, we all accept that they'll go up and down over time, and it's a very long-term view. Whereas a lot of the, it's been a while since we've had a housing market crash in this country, so I think that sometimes gets left out of the conversation. So could you say a bit about that?
Yeah, absolutely. So the returns I presented are forward-looking 10 to 15-year horizon average annual returns. Mm-hmm. So they're very much assuming that the data I showed was property as a whole, so it assumes that property capital values appreciate over time. Mm-hmm. It does also assume that there is an increase in the rental income or the owner's equivalent rent on those assets. The yield effectively stays approximately the same. I suspect, I can't remember off the top of my head, but I suspect the capital appreciation is the larger part of that. But if you get a correction in price over a 10 to 15-year horizon, you probably make it back up again.
Yeah.
So in long-term averages, although the crisis when it happens is horrible, it tends not to actually drop those returns terribly far.
Yeah, that makes sense. Thank you. All right, now we're going to hear from Damon Hopkins from Broadstone.
Thanks, Karen. So I'm Damon Hopkins. As you might detect from an accent, I've probably been picked on because I am originally from South Africa and worked in the pension consulting space in South Africa. But today I head up a DC consulting team at Broadstone, and I guess I was interested in the topic because it's close to all our hearts, I think, as an industry, around adequacy, around the things that challenge pension adequacy. But I think a few overarching points, and without wanting to reiterate and repeat, albeit I think it's worthwhile, what my fellow panelists have said, I think it's really important for the retirement adequacy equation that we mitigate the amount of housing cost in retirement, and particularly rent. That's far easier said than done, but that's kind of what we're here talking about and considering solutions. I'm going to be talking about this concept of pension pledging in South Africa, which they actually call pension-backed housing loans, but that is not a concept unique to South Africa. So, for example, they use it in Singapore, they use it in Switzerland, and in fact go one step further in that it's not just an option to use your pension pot as collateral towards a housing loan, but you can actually access it directly as well. So we're talking about South Africa here. I'm not putting South Africa on the pedestal next to me as some gold standard or the utopia, or certainly a silver bullet to the challenges we're facing. But I think it's part of a multifaceted approach that as policymakers and as an industry we need to be thinking about innovating with. So pension pledging, as I say, it's called, in South Africa it's more commonly called pension-backed housing loans. It's very prevalent in terms of the existence. So it's been around for as long as DC savings has been in the UK, so it's a fairly mature market, talking about the best part of 30 years or more now, so quite established, and I think probably for pockets of the population quite valued and quite well utilised. It was primarily born actually from an informal employment and housing sector not having long-standing credit history to be able to access mortgages and that sort of credit line. So there was a different way of accessing credits through using a pension pot. So how it works is quite simple. It pretty much is what it says on the tin. It's a personal loan which is secured up by a DC pension pot up to the value of 60% of that pot, and it's provided by a bank through a tri-party agreement between the employee, the employer, and the bank. It can only be used, as I said, up to 60% of the value of the pot. It must be used for housing purposes, so renovations, deposit, purchase of property, and it must be a primary residence as well. The DC pot remains untouched, so the money continues to be invested in the normal way, and it's only called upon if there's a default in repayments or indeed there's a change of employment. And monthly repayments, and again this adds to the collateral of the deal, as it were. Monthly repayments are paid via the employer's payroll, and it's subject to the usual credit and affordability checks that you would expect from any loan. So that's a bit of background as to what it is. The advantages of pension-backed lending or pension pledging over a mortgage or personal loan, for example. I think in the South African context is an interesting one. Some of the socioeconomics at play are an important factor. And in particular, like here, interest rates for any borrower are based on that person's risk profile. At the high end of that risk profile, the interest rates offered through pension-backed lending or pension pledging is often better than personal loans or mortgage rates. So interest rates are competitive. It can be used for a deposit towards a house as well as amongst other things for the purchase of a property or indeed renovations, etc. The term is longer than a personal loan, so it's up to 20 years, but it can't go beyond anticipated or normal retirement age. There's no second charge on the property, so no additional mortgage, which makes it very accessible. From time to application to the point of funds reaching the bank account can be 5 to 10 days, so it's very quick, very accessible at reasonably competitive rates. So, sounds good. I was asked to provide some good news, some positive thinking, so hopefully that's a good start. Just temper that a little bit, unfortunately. So there are a few things that we need to bear in mind when we're looking at what's happening in South Africa, how this works in South Africa, and what's happening here and the challenge we face. The first thing is the DC market is more mature than it is here, so it's been far more prevalent for far longer, which means that the average pot size relative to average earnings is much higher in South Africa, and indeed the cost of housing as a percentage, or rather the percentage, the value of a DC pot as a percentage of cost of housing is much higher as well, right? And that's a function of two things: people saving in DC for longer, and housing costs being nowhere near as expensive as they are here. So why that matters is that what it looks like in numbers, if the average value of accrued UK DC pots versus the average property value is something like 1 to 2%. The equivalent number in South Africa is about 10 to 20%, right? So that matters because it implies that you have far more material savings that you can leverage for these loans, whereas in the UK, given the relative immaturity of DC, the average DC pot is very small compared to the average property value. So that's not an insurmountable issue, but it's one to bear in mind, given that, that this is not a silver bullet, and certainly not a silver bullet in the short term. The last point is the preservation rules in South Africa, and that's a really critical one, particularly for policymakers to bear in mind, that currently the preservation rules in South Africa are such that you can access your pension pot at the point of changing employment at any point prior to retirement, right? So it is taxed, but it's fully accessible as and when you change employment. Interestingly, from March next year, they're introducing a two-pot system where 1/3 of the pot will be fully accessible for any reason whatsoever over a member's working life, but can only be accessed once a year. The second third of the pot, or 2/3 of the pot, will be subject to mandatory preservation, and only that portion can be used for these pension-backed lending products. So what does that mean for the UK? Well, I've kind of alluded to why this could be part of a solution, but certainly not the silver bullet, is that clearly for this to work, preservation rules will have to be relaxed at the very least, or materially changed in their flexibility. So for the security to exist, the pension pot's got to be accessible before retirement. Modest average DC pots versus property values means that, you know, in the short term for the average member, the support that this will offer will probably be confined to small amounts and confined to people with more meaningful DC pots. And in fact, if we looked at most first-time buyers today and the deposit that they'd be aiming to get versus their accrued DC savings would be materially different. That said, if we were just to hypothecate and say your average, and the last time I checked, I think the average first-time buyer is about 33, 34, with auto-enrolment and hopefully people being auto-enrolled younger, if a saver's started saving for 10, 11 years before the point at which they buy a property, one would hope that they've accrued a reasonably material sum that they could potentially leverage through an arrangement like this. So I certainly think it's worth considering as to whether the medium and long-term appeal of this might be helpful. So, in conclusion, unfortunately, I'm going to finish on a slightly negative note. It's unlikely to be, in fact, it won't be a silver bullet. So this is not, as I say, this is not a utopia. Certainly, the South African system, nor any other system in the world is perfect. And if it was, we'd just simply replicate it. So, not a utopia, but I do think, as part of the challenge that we've got in managing home ownership, the cost of ownership, and mitigating that cost into retirement, that it is part of a potential multifaceted solution amongst some of the other things I've stuck up here, which no doubt we'll explore in a bit more detail.
Fab, thank you very much. So Damon, before I bring in the rest of the panel and then go to the audience for questions, I have a few silly questions for you, I think, just to make sure that I've understood. If you use this product in the South African model, what are the implications if you don't own your home outright by the time you retire? Does that have implications for how much pension income you may have?
So yes, it's the same as a mortgage. That ran to a certain point. If you still had an outstanding balance at the point that you retired, and they won't allow that to go past normal retirement date. But if you took early retirement, you would be able to redeem the pot, and part of that redemption, they would have first charge in the same way as a mortgage might have first charge of the property. They'd have first charge in your pension. So it would have to be redeemed. And in fact, the members probably not even party to that and would be redeemed at the first point of redemption.
Okay. And with how the products sit, if you have taken this product, does it mean that your pension pot is actually in effect smaller while you're paying it back, so you would accrue less interest, or no?
No, it's the pot is completely unaffected.
Okay.
So it remains invested as if you didn't take the loan. It's only called upon in the event that there's a default or a change of employment, which is unfortunately complicates the system. And I think if we were to rewrite that script in the UK, we would make it more seamless to transfer between employment, because the tri-party nature of contracts, as I set up in the South African context, is employer, employee, and the bank. So a change of employment triggers the loss of one of those parties and therefore ceasing of the contract.
That is fascinating. Thank you. Yeah, well, I'd like to bring in the other two at this point, just to get some responses from you about the pension pledging idea and how, if you think it would be workable in a UK context and what that might look like.
Yeah, happy to go first. I mean, I've been thinking about the challenge of holistic lifetime saving, including both housing and retirement income, for several years, but never getting beyond posing the problem rather than trying to come up with a solution for it. And I think this is probably the best or smartest way to solve that problem I've come across, and haven't come across it before being invited to join this panel, I think. And so I think it's certainly for people here today, definitely worth thinking about more about what that would mean in terms of how it could be delivered in the UK. In terms of whether, to the extent to which it's a solution, I mean, the problem we're trying to solve for is, or the problem that this helps with is, if you need to save up a certain amount to own a home and retire with the income that you desire, what is the way in which we can do that requires you to save the least? And I think what the pension pledge does, if achieved, is, I think, minimise the amount you need to save in total, more so than I can think of any other approach. So then the question is, and that's what this can help with. It doesn't help someone find the money to save up that amount, and that's the big challenge. You know, will they have enough money to save up that amount, or is there aspiration for both housing and retirement income too great? It doesn't solve those problems, but it potentially minimises how much saving is needed. I think the other thing it can do by is a bit more around the behavioural economics of it. So at the moment, you need to think about, I'm trying to save all this money into an ISA, I'm trying to get that housing deposit, and I haven't really thought about my pension over here at all. Two, all I need to do is get all the money I'm trying to save in this one big pot, and then when it's time to buy a house, I can just use the pension pledge and then use that, get in the housing ladder much sooner than I would otherwise do. And then, well, I may as well just carry on doing the saving and I'll pay the mortgage off. And I think you get through much more defaulting people into a combined retirement income and housing habit, potentially also increase the amount of saving people do. So you've both got minimising the total amount of saving because you were able to invest that, you're not having to put it into cash savings for 10 years while you build up a deposit. And you've got that behavioural economics trick of actually nudging people into much greater levels of pension saving earlier in their lives. So I think it has a lot of potential. I've no idea how you'd do all the stuff around preservation on all those bits, or what would happen if there was a default and all that sort of stuff. But I think they're things that can be solved.
Yeah, the thing that strikes me as compelling is, as you just said, that kind of unsiloing of how people think about savings, that it's just this is a big savings pot and I'm going to use it for different things. Any reflections from you, Liz?
Yeah, I mean, I also hadn't come across it before being invited to join this panel, and I think it's a fabulous idea. I mean, just making things as simple as possible and then using those assets as hard as possible. I mean, that's what investing is all about, and this feels like it gets us a long way down that path. I mean, I think there are some technical challenges to overcome in terms of what happens in the event of a default, and whether in really bad outcomes you make the problem even worse than it is currently. So I could see a really very nasty cliff edge at that left tail of bad outcomes, and I guess one would need to get comfortable with that. But yeah, I would have thought you can set up the incentives for the lender to want to support this over time if you think about it hard enough. And I haven't thought about it hard enough as yet, I will confess. But yeah, some good homework, I think.
Yeah, very, very, very interesting. Any responses to that from you, Damon, before we?
Yeah, I mean, I think it's, I had the benefit of being a little bit more positive, and that was the brief. So I tried to be, but I do, without sounding too cynical, think that there's it's a multifaceted problem that needs multifaceted solutions. And I think it's not just about, to your point, how you can access more money, it's how you can put more money in or afford to put more money in. And I think flexibility needs to start at an earlier age in a slightly more simple way, so that there's not an ISA, a LISA, a pension. It's one thing that is more flexible than it is today, because A, I think that incentivizes more going in the first place, and B, takes care of a whole lot of other financial demands simultaneously.
Great. Yes, well, I would quite happily keep asking you questions for a while, but it seems like from previous sessions we have quite an engaged audience, so I want to give us time to get questions from the audience. So shall we go to that now? And if no one has questions, I have plenty more I can ask. So I think we'll probably take some groups again. Yeah, so I think there's someone in the back in black and someone in blue here, and I think we have some from online as well, so we'll take 3 to start.
It's Rennie Biggins from Tizer. Thank you for that, really interesting. A question for Damon. Is there any sort of evidence to show how the pension pledge incentivises contributing into the pension?
No, in short, not that I know of. I must admit that I've been out of South Africa for 13, 14 years, so I don't have a handle on all the data that comes out of it. But it's certainly reasonably popular. So the interest is something of, sample scheme is something in the order of 10%. I guess the bigger incentive is that there's very loose preservation rules. So the reality is that they can put money in, and if they change employer, they can take it all out. So I suspect there's not a singular dynamic driving incentivization. It's probably a coupling of, yes, we can access some of it indirectly for housing, but also we can access it all in cash if we need it.
Thank you. Sorry, one other quick question. With the looser preservation rules, how does that translate into what people's retirements are actually like? Is it being shown that people are materially having reduced retirement living standards because of those preservation rules?
In short, yes. So South Africa's two-pronged problem is participation, but to a greater extent leakage, which then affects adequacy. So that's their big challenge, which is why the reforms I spoke to about introducing this two-pot system are being introduced. Yeah.
And is government picking up the shortfall for those people in retirement?
In short, no. Not to the extent that it needed.
Thank you.
Hi, Taylor Weeks from Schroders. We spoke before about a few of these things, but I thought we could kind of open the conversation up to the rest of the group. You say there, Paul, around potentially reducing the costs or minimising the amount of saving. Another way of saying that is increasing risk in order to facilitate higher returns, effectively, because you're doubling up on the economic exposure through your mortgage and your the ownership of the house, which is leveraged, and then you've also got the pension pot, which, if it's a traditional lifestyle and you're in your 30s, is probably all in equities, and if something bad was to happen, that could be an issue. I just wanted to get more thoughts on that side of things. And then the second point is, more generally, are we looking in the rear view mirror to solve this problem a little bit? You touched on it earlier, Paul, but it seems to me that actually the cause of a lot of this talk around housing is actually monetary policy and macro conditions. And to what extent are we trying to solve a problem which it's kind of a drop in the ocean relative to those bigger forces? Thanks.
Should we take one from Joe as well?
Yeah, I'll stick with, there's questions about other parts, but I'll stick with the South Africa model for now. So there's a couple of sort of questions on how it works. Does it result in lower worker leaving rates, less turnover? Does it incentivize employees to sort of stay in the role that they're in? And also, kind of more broadly, are there barriers or constraints in the UK that would make it kind of less workable as a suggestion? Like what would we need to get over to make it happen?
Mm-hmm. Great. Okay. Very interesting questions, everyone. So, yeah, we've got a bit of a challenge around, if we do just have this one pot of savings, are we really increasing the risk return there? And then I think a very good question for us to consider of kind of how much are these wider wider issues that are potentially beyond what the retirement system should be trying to do or could reasonably be expected to do. And then a few questions for you, Damon, as the South African expert, about exactly how that scheme works. Does it lead to less turnover for staff? And maybe some more reflections from the wider panel about if there are kind of UK barriers that might make that scheme difficult. So who would like to tackle any of that?
Yes, some complicated stuff there. Just try and wrap head around it. So I think you minimise the amount of saving that's required because you are able to make your money work harder. So you can start to invest that from the get-go, compared to now where you would just be putting it in cash because you're planning to get that housing deposit 5-10 years time. You'll be able to say, well, this is long term now, I can put that into long-term investments that I don't really need for 50-60 years. And I think that's why, so that doesn't necessarily, well, it creates risk, but that's kind of the risk reward in a long-term investment. But I think what we haven't touched on is then what happens if there is a default, because then your big pension pot is exposed to that. And I think the way I think about that is it's a bit of a different world, or at least now if we think of these pots as separate, we've got our kind of cash pot over here and our pensions over there. If there is a default, I've spent 15 years saving up for this housing deposit, house price has gone up, I've just lost my 15 years worth of savings, but my pension is secure. To a world where we'd be, well, I've got this big pot and I've lost a chunk of it, and I don't see there's much difference between those two. Obviously, for the small number of people who'd be in that situation, who didn't have equity in the house and were therefore having to draw down on the investments to recover any arrears, etc. That's a small population. But for most people, I think they would be able to use that pot. The pensions would stay invested. They'd start to be paying down the mortgage. They'd build up equity in the house, and then move beyond that stage where that pension pot is at risk. And actually, what they've been able to do is lock in their first 15 years of intense saving activity into investments, which will be able to contribute to retirement income later in life. They're able to start on the mortgage housing ladder earlier, pay that off, particularly as their income grows later in life, and over repay the mortgage, etc. So by the point at which they get to the end, they're in a better position. So I think it's the ability to do all of that together, rather than kind of spend all this time saving a housing deposit in a very inefficient way. That's the potential.
I think to build on that as well, a particular aspect of the UK housing market that I spoke about earlier is that if you're in owner occupation, you're probably spending less on housing costs. So if you're in owner occupation, it may be easier to save anyway. And then obviously, if you're in the private rental sector, you're spending more of your income on rent and you're not accruing any equity through that, whereas most people in owner occupation will be. So that's that kind of double bind of once you get into owner occupation, it's actually easier to save as well in this country, particularly in the south of the country at the minute, just because housing costs are so high in private rent. So yeah, other thoughts from the panel?
Yeah, I mean, a few things occurred to me. One is that the beauty of pension saving is that it's long horizon. So the fact you have a drop in the market like 2022 actually isn't the end of the world. I mean, clearly one would rather everything went up nicely in a straight line, but that's not life. But because you're saving over a very, very long period of time, actually that drop, a bit like the house expected return that we talked about earlier, it would be better if it didn't happen. It's not the end of the world that it does. The second mitigation is if the loan to value of the pension pledge against the value of the property is limited to, I think you said 60% of the value. And presumably there's some limit as well of how much of the house purchase price can be used.
Yeah.
So it would be highly unlikely that you would lose, even if you allowed, say, a 25% of the cost of the property to be bought using the pension pledge, in the event that you default, the bank will come in and sell your property. You might not lose any of your pension pledge at all, provided they can sell it for more than 75% of the value you bought it from. So we may be catastrophizing something here, and if you get that loan to value point at the right level, then that might not actually be a risk that crystallizes. A couple of other thoughts. We don't believe in undiversified portfolios, so even if you're in your 30s, you shouldn't be 100% in equity. You should have a spread of assets in there. That's a Nest investment belief. And the second one is, yes, interest rates have gone up a lot recently. The period since the GFC is abnormal. If you look back in history, the interest rate levels we're at now are about average over a 40, 50, 60-year horizon. The period that is abnormal is when they were down at 0.1%. And so, yes, this is a horrible adjustment period where we go back to more average levels, and hopefully if inflation can settle back down in the 2 to 3% range, then interest rates can settle back down into the 3 to 4% range. I think we actually should all be wishing they don't go back to 0 to 1, because that was a dreadful environment for the economy. Nominal growth was very, very low. Real incomes didn't grow, and so I think we should be careful what we wish for.
I'd only add, it's all been well said, only add one additional comment about, are we looking in the rearview mirror, and are we concerned about things that are perhaps feel acute? I think the reality is that house prices are going to be disproportionately high while there's a supply problem, and therefore there's going to be a tension between how much you can save and how much you can expend on housing for the foreseeable future. And so until that changes, I think it's going to be a dilemma that needs a solution.
And do you know if the schemes in South Africa have any impact on staff turnover?
So again, don't have data to hand. Intuitively, you'd say yes, because it's hard work, and especially if you've relied on that loan, and you don't want to. You're particularly concerned if your new employer offers the same scheme, and this is the complexity, which I think if they had to rewrite the rules, they would do differently. But it's almost impossible to transfer those loans between employers, so it's got to be redeemed.
Right.
So I would suspect that there is a little bit of that. I think the counter to that is that if you leave employment, you can access your pension pot. So if there's another financial, if you're facing a very acute short-term financial crisis, it might actually be in your immediate short-term interest, or perceived to be, to leave employment, stop earning money and get your money on your pension pot, which is not a good place to be from a long-term retirement savings perspective.
Great. Shall we take a few more? We've got time for a few more questions. Right, I think the gentleman over here had his hand up before, so we'll start with him and then maybe come to the person in blue and then take another one from online. Yeah, great.
Thank you. Pete Glancy from Scottish Widows. We heard from Will this morning a reminder of the success of auto-enrolment and building up retirement pots, and then we heard after that the need to build up financial resilience, short-term savings, and this afternoon part of the chat here has been about building up savings to get onto the property ladder. If you've got £3 a month that you can save, you can put £1 into each of those 3 pots. But for many people today and going forward, they've only got £1 a month to save. Is flexibility an inevitable part of the solution?
Shall I ask my question now?
Yes.
Cool. All right.
Sorry.
So it's Nathan from Hargreaves Lansdown. Damien, I'm just really interested in that idea, full stop. I think the biggest challenge I can see is the involvement of the employer, particularly when we've got high turnover. I'd love to speak to you about it separately. There's an interesting angle for the self-employed, who we know are underserved, but also if you allow employees their choice of pension provider, irrespective of employer, that opens up that idea massively. So I think that's definitely worth investigating. But to the whole panel, I was just really interested in any thoughts that you had around downsizing, because we know that often we've got big houses, that are sort of left with only maybe 1 or 2 people living in them, is there an opportunity to incentivise downsizing? Because we know it's quite an emotional drain from our experience to actually make the final decision to move away from the house that you've been living in for years and years.
Joe?
So lots of interest in the supply side question and the role that pension providers could play. Interest with Liz's ideas. So how close is the UK to pension schemes playing a role in, for example, shared ownership and kind of house building? And then interestingly, flipping it the other way and looking at retirement housing, would sponsored independent retirement housing or public-private partnership help with this?
Great. Okay. Yeah, some very interesting questions. So how much is flexibility going to be necessary, especially when we are dealing with a time when many people are struggling to save it all? And then should we be incentivizing downsizing and other kind of supply side things? What appetite is there for pension providers to play a role in shared ownership or retirement housing? Who would like to take a first stab at any of that?
I'll take the flexibility one simply because I think it's pretty consistent with some of the themes I had on my last slide, which is I think it's imperative. I hope it's inevitable. I think if things are more flexible, you're more likely to put your money into it. We've got the participation relatively nailed in savings, and that's really good. What we haven't got is the adequacy. So we're heavily reliant on people putting more in, and I think, frankly, the only way that that's going to become universally possible is to have more flexibility, with some, with a very close eye on preservation, etc. I hope it's inevitable.
I can maybe have a stab at the downsizing and shared ownership questions. So shared ownership does already exist. My former employer has an investment in a shared ownership fund, and so it definitely is out there as a thing. I think it's not something we've looked at Nest. There would, I suspect, be challenges around the cost of those solutions. As you know, we try and keep our costs very low, and we generally manage to do that by buying at scale. And people who have a product that is capacity constrained generally won't want to do business with us, but it's something we could investigate. On downsizing, I think it's actually linked to the question of more construction of new properties taking place, because I think one of the challenges is finding somewhere attractive that you want to go and live, because quite often the smaller apartments aren't necessarily designed with an older person or older couple in mind who might still want one spare bedroom or two spare bedrooms in case the children and the grandchildren come to stay. A lot of the new build that's going up at the moment is typically one bedroom, possibly two bedroom properties, but very small floor prints, and an older, mass generalisation, but I suspect older retired people, they've accumulated more stuff. They're used to having space, so going back to micro-sized apartments isn't going to be attractive to them. So building something which is more designed to the aspirations of that group might be a way of encouraging them to move out, make it somewhere they want to go and live. I've decided to be offended because I keep getting through the door leaflets for retirement accommodation. Quite why, I have no idea, but apparently there's some very nice places I can move to locally that will have a cinema and a gym and a restaurant, and that seems to be trying to cater to that kind of market, clearly at a certain price point. But yeah, I mean, pension funds do construction build. It is more risky than buying established assets, so you will never put a lot of your portfolio into it, but yeah, construction does already take place.
Any reflections from you, Paul?
I think on flexibility, I think completely agree that more flexibility to solve these different challenges can build on the success of automatic enrolment, which has increased long-term savings for people who aren't engaged. But they're probably in that world, and the world we're talking about, AE has the advantage of being very simple, and I think as you start to think about these other things you can build into that, it becomes more complex, and we get into a bit of a cycle of increasing complexity where we created simplicity. I think that probably suggests that there's a real importance in how we make it easy to engage with, so that it's actually easy, not just to understand, but actually to see how much you've got, to think about where the sidecar bit of that is, to see where the housing savings is, to adjust the things you need to adjust. And I think the user experience of that will be really important in a way that AE hasn't needed to do that so far. So I think we need to think about, we're asking for flexibility, but I think you need to then deliver this kind of ease and user experience for savers.
Yeah, very good. I think we probably have time for maybe just 2 more questions, because I don't want to eat into people's tea time. So yeah, we have a question down here, and then we'll take one more from online, I think.
Thank you. Matthew Blackstone from Nest Insight. One of the things I think is underlying a lot of the discussions we're having today is the very different circumstances that different households are in, and the difficulty of adjusting a whole system to meet those heterogeneous needs. So Liz, you were speaking about what investment systems might need to do to support the needs of those likely to be renting in retirement, but it seems to me that if you're an owner, your incentives are exactly the opposite end of your correlate. You probably want assets that negatively correlate with house prices. And so I was just wondering, first of all, how you sort of account for that as an investor. Do we need to know whether people are homeowners or not to invest wisely for them? And relating that to the South African example, it seems to me that if you're in that sort of in your 20s and trying to build an asset in a pension that's going to be collateral against a housing loan, you presumably are incentivized to invest in those real estate matching assets, and then very suddenly, again, you're not. So I just wondered if we actually see that reflected in the investment practices in South Africa.
Should we take one more final question?
Somewhat related, so it would be good to take them together. So this is a question from Slido, again around different circumstances. So Paul's slides focus on outcomes for couples. What do we know about how relationship status affects long-term financial security? Any ideas as to how to level that out for different household setups?
Yeah, really like that question, because I think along with the assumption about housing costs in retirement, there's also potentially an issue about assuming that people are in couples. So yeah, two questions, and I think we'll try and keep the answers quite brief so we can go to break. But yes, so basically, how do we invest? Do we need to know people's housing tenure to invest for them well? And what do we need to know about people's relationship status and how that may impact living standards as well?
Gosh, should I go have a first stab at this? So I think generally it would be useful to know a lot more about people's household circumstances. Are they in a couple? Are they just an individual? Because at the moment all we see is an individual's pot that they have with Nest. We don't know about their other pots outside of Nest. We don't know about their other savings. And so we have to invest on the basis that that is what they have, and therefore we take a certain risk-return decision based on the size of that savings pot. If we knew a lot more about them, we might take quite different decisions. How one solves for that, I don't know.
Final thoughts from
I was going to say, do you want me to ask the question around whether the approach to investment changes? No. The take-up, or at least the interested take-up of pension-backed loans is only about 10% of membership. So we're talking about designing default, 90% are in, you can't really accommodate the 10%. So the short answer is no. I mean, I do wonder whether, to the point of the world we're living in and having more access to more information will certainly help. Designing solutions will help if we know people's needs. It's as simple as that. So I would hope that that picture evolves. But I also think single flexible solutions which do introduce some complexity but actually offer fairly simple solutions allow for some of that nuance.
On the couples point, it was actually as I was doing the calculation, the working out those illustrative examples, and realising that a 3-bed property in Margate would be unaffordable for a single person to ever be able to save up enough pot and devote the savings to be able to afford that as well as a retirement income. Which is why we used a couple in that example. But also I think it shows how important it is relationship status in this, but also how difficult it is to really understand any individual's finances, because I think once you operate your finance as a household and partnership, including potentially children as well in that household, where and work for banks for many years, where the money goes, which accounts sit with different providers, which pension, where the savings are held in whose account, who's got the premium bonds, who hasn't. I mean, it's just impossible to get a grip on as any kind of provider. I think I just don't think you'd ever get there. Open banking, open finance is a possible way through that, and you can kind of aggregate things. But even there, there's no point in me aggregating all my products without aggregating everyone else's, my partner's products. So I think that is a real challenge. I don't think the industry has solved. And what I've seen from things like open banking, they've not really tried to even address some of those kind of joint financial management challenges. But they sit along the other challenges we talked about today as well, I think.
Great. Well, thank you very much for your excellent questions. So, I mean, just in terms of, to go beyond stuff is really hard, which I think we all agree. I'd be really interested to hear from the panel kind of a final thought or a call to action that you'd like to kind of take the room to take away from this session. If I start with you, Damon.
Horribly cliched, but I think whether it's policymakers, whether it's the industry, whether it's investment professionals, whether it's providers, is continue to innovate. Without wanting to contradict my panelists, I think I wouldn't be too hung up about simplicity. If something works, people will engage with it, right? If we need this is a complex problem, if we need complex solutions, let's do what needs to be done to fix the problem, and that's going to need innovation.
Yeah, I think I'll go for encouraging asset managers to try and work out how to expand the shared ownership model at affordable cost for a high quality, low cost scheme like Nest.
Fab. And you, Paul?
I think we probably haven't answered the question of should the pensions industry, is this an issue for them to solve? I think you raised it a little bit earlier. I think if the purpose of the long-term savings association industry is savings adequacy, income adequacy in retirement, and it has the capability to do something about it, I think then the onus is on the industry to really start thinking about solutions and delivering them that include both housing and retirement income.
Great. Well, thank you very much to our excellent panel and for all the great questions. And I think now we have a short tea and coffee break. So thank you very much. Thanks very much, everybody. That's really interesting. Yeah. I really enjoyed that. Hopefully everyone else did too.
All right, I think we're about to go. Whoa, whoa. That's one way of getting everyone's attention. I think we're about to go live now, so I'm just going to ask for a little bit of hush in the room so everyone isn't too overwhelmed by the noise. Great. Well, welcome back to all our remote attendees and also to everyone in the room to our final live streamed session of today's event. My name is Matthew Blackstad, as you actually just heard from my question, and I'm the analysis director of Nest Insight, so I tend to lead on projects which major on the use of data to try to address some of our research questions. I'm about to introduce our very distinguished keynote speaker for today, who's going to deliver a talk which I think will really speak to a lot of the questions that we've been addressing over the course of today. But just briefly to introduce Taha, I wanted to return really to where Will started, right back at the beginning of his introduction to the day, which is to talk about both the incredible success that auto-enrolment's been in this country in terms of creating that massive inflection point that Will showed you in terms of the number of people now saving for a pension when they're in work in the UK. But at the same time, just ask this question that's been left hanging really ever since the policy was introduced, which is the yes but question. We know that in that sort of headline definition of success, auto-enrolment has been hugely successful. It's increased the take-up rates. But ever since then, and particularly as we've been exploring the sort of wider contextual questions that sit around automatic enrolment, we've also heard over and over again a number of really, really important questions about what the potentially unintended consequences or knock-on consequences of automatic enrolment might be. And this isn't totally universal kind of coverage of them on this slide, but what I've tried to do is divide them into a few headings. So a lot of people might say that auto-enrolment is too much of a one-size-fits-all. As we've heard today, but we certainly see over and over again in the Nest data, when you auto-enroll a population, they tend to take what you give them in terms of a default. And so not only the default investment strategy that we've just been speaking about in the last panel, but very particularly the default contribution rate that's provided for you by the policy tends to be what people stick to. And that clearly is very unlikely to be exactly the right level of saving for all those people. Secondly, potentially does it work too well? We've been talking about the tremendous liquidity pressures and potentially tremendous debt costs that a lot of households are under, particularly in the current economic circumstances. And yet until very recently, where we potentially start to see a little inflection point in Nest in terms of the number of people stopping their contributions or opting out, that's remained very, very static, apart from a little bumpy ride during the pandemic, which is probably more caused by labour market disruption than by people's behaviour. We've seen this very constant opt-out rate of less than 10%, right through a labour market disruption, right through a period of intense cost of living challenges. And so, again, is that going to be right for everyone? There's been an awful lot of commentators who are saying clearly not, and what can be done about that. And then, and this is probably the question we're going to focus on a little bit more in the next 40 minutes or so, are there knock-on consequences, are there unintended consequences of doing automatic enrolment? Will alluded in his opening talk to the fact that when you introduce a policy like automatic enrolment, your presumption is that basically you're going to introduce a policy that's going to just slice a bit off people's take-home pay, and they're going to have to accommodate that in their household, and the way they'll do that is by reducing their consumption. But you don't have to think about that very long to suspect that that might not be the whole story. And the more we look at the population that Nest is here to serve and that Nest Insight is here to explore and support, we recognise that people who are on low to middle incomes are much more likely to have to make trade-offs to cover the cost of that contribution that they haven't chosen to make to their pay. And a lot of that may not be being done consciously because they didn't make that change themselves. Happily, I suppose, although the picture that's painted here is not all a very happy picture, what we've had over the last 10 years in the UK, from a researcher's point of view, particularly a data-led researcher's point of view, is a really helpful and valuable set of potential natural experiments that we've been left with by the rollout of automatic enrolment. And we're here to talk about a few of these, but just briefly to say that from the point of view of Nest Insight, we're trying to explore all of these at the moment. So first of all, going back to 2012, and I'm just showing the last sort of section of this, as small employers came in these orange bars, this is the volumes of employers coming in through the staged rollout of automatic enrolment. This last stage, which I'm showing here, is employers with fewer than 30 workers who were brought in basically at random. It was the last 2 digits of their PAYE reference that defined which month, over nearly an 18-month period, they were going to be brought in. And that makes a difference to the individuals who've been enrolled are having to pay a contribution, to the employers who have had to enroll them and pay a contribution that's basically randomized. So we've got a really interesting potential area for exploration there. The next phase, which you're going to hear a bit more about in Taha's talk, is the point where the contribution rate went up from, in gross terms, just 0.8% to the individual to 4%, a multiple of 5 over the course of 1 year and a day, as the contributions were ramped up. Again, a really useful point where we can see some discontinuities. We can experimentally look at what that did to people. So the first set of questions we can ask in the subheading there is, how does automatic enrolment and the way it was rolled out affect people's use of credit, people's other forms of saving, and people's consumption, the whole household balance sheet? The other question which we then got into was massive labour market disruptions, and now going off the edge of the chart there, a period where obviously people are under significant liquidity constraints. So we can ask the inverse question, which is, how do all these disruptions in the economy affect automatic enrolment and the way that people behave? So that's really what we're trying to do, and in a range of projects that we're working on at Nest Insight, supported by a number of our funders, some of whom represented in the room, JP Morgan Chase, BlackRock, the Money and Pension Service, and the Nuffield Foundation. We're doing a range of projects where we're using the Nest data that we hold, but also matching those data at the individual level with other data sets that are held elsewhere, that can give us this more comprehensive picture of the whole household balance sheet and help us understand what some of those knock-on consequences were. And just by way of example, although Taha's going to show you something much more comprehensive in a moment, this is just some very, very early sort of sneak preview of some results in the study that we've been working on with a number of collaborators. There's a sort of laundry list of collaborators at the bottom there over the past few years, which has come to fruition, which is looking at how people's credit was affected by being auto-enrolled. And again, you know, if you want to take the policy assumption, you're auto-enrolled, you're just going to reduce your consumption a bit to cover that cost. But what we actually see, this is just looking at credit, different forms of credit, is, I'm sorry, I've just realized my first bullet is wrong, because we've only just discovered an effect, and I should have deleted the first one. We see zero effect on vehicle finance, which is something that's actually slightly different from a similar study in the States, but that's quite interesting. So a secured loan that people aren't necessarily more likely to take out when they get auto-enrolled. But where we do see the effects is in a couple of areas, and they look quite different. One of them is you're a bit more likely to have some unsecured debt. So for every month that you were enrolled earlier than someone else, you're paying a little bit less than £30 extra on average in terms of the contribution that's being paid, of which we see about a quarter, just over £7, coming in the form of additional unsecured debt. This is overdraft balances and credit card balances. And that varies by income, as you can imagine. So higher earners, it's a bit less. Low earners, it's a slightly larger percentage of that amount that's accounted for in unsecured debt. The other thing we see, and this is an incredibly small number, 0.05%, but because we have such a huge sample of people, we can tell you that that's a statistically significant change in the number of people taking out a new mortgage. And overall mortgage balances do rise a little, but then so did house prices, so that's no surprise. But just thinking back to that previous sort of panel discussion, we're talking about the difficulty of this population accessing mortgages. This isn't going to be everyone, clearly it isn't. But isn't it interesting how just being auto-enrolled, and therefore having a pension at work, doesn't affect anything about your credit status? Mortgage lenders might be more likely to look on that as a negative because you're contributing more to a pension, therefore your income's been depleted, and yet you're more likely to have taken out a mortgage. So what this is saying to us is just that there are a tremendous number of interactions between being auto-enrolled and all the other things happening in your finances. We also, by the way, see that none of this is affecting your credit status in any negative way or your likelihood of default. Now that's just one set of results. We'll be putting out a discussion paper on that very, very shortly through the National Bureau of Economic Research in the US, which I hope all of you will read and enjoy. But in the meanwhile, I don't need to spend any more time on this because we have a very interesting set of results that already exist coming from our speaker today, Taha Choukhmane. And Taha is Assistant Professor of Finance at the MIT Sloan of Management, having previously been a postdoctoral fellow at that very National Bureau of Economic Research that I just mentioned. And his research interests lie in the intersection that we're talking about here between household finance and behavioural economics, and particularly a focus on savings decisions. And we've been fans of Taha's work for quite a while and co-collaborated with a number of people he's worked with. And we're particularly interested in the innovative work that he's done. You'll hear about this now, using large data sets to explore those knock-on effects of automatic enrolment interventions. So I'd say we're really delighted that he's come over from the US to be with us today, and please do join me in welcoming him to give this year's keynote.
Thank you. I'm delighted to be here, and I want to thank the organizers for inviting me, for putting together a wonderful set of panels. I've learned a lot. I spend my days thinking about retirement policy, and I still find myself learning a lot in these panels and what I heard today. So, I think my first slide is missing, but that's okay. So for this presentation, I want to cover evidence from 3 studies, 2 in the US and 1 from the UK, studying the UK auto-enrollment setup. And I'm going to try to draw from these different studies some general principles about how to design better retirement policies. And here I want to think about retirement policies pretty broadly and think of the broad set of instruments that government can use to get people to save more for retirement. That includes mandates, such as Social Security. You can just mandate that people set a percentage of their salary in a retirement or public pension. Financial incentives. Most OECD countries have a tax advantage for saving for retirement. A lot of employers give matching contributions. And behavioral interventions, nudges, changing the default option. And what I find really interesting about the UK auto-enrollment policy is that the UK policy kind of combines all these 3 elements. There is a mandate for employers to provide a pension. There's a change in financial incentives. If you opt out, you lose an increasingly large employer contribution. I think 3 years ago it was 1%, now you lose a 3% employer contribution if you opt out. And then you have the behavioral nudge, changing the default option. And so I want to start by introducing a simple framework. It's built on some more theoretical work that I'm doing with my co-author Christopher Palmer to think about when do retirement saving interventions create a positive change. What is the benefit from these interventions? The first benefit from such an intervention is quite simple. It's that you get people to save more for retirement. You get an increase in retirement contributions. It's a direct effect. However, this increase in retirement contributions may crowd out other assets. Okay, so if for every pound of additional retirement contributions, people reduce their outside savings by £1, they're left with no more resources available for retirement. You just take money from one account and you put it in the other account. It can even get negative. If for every pound of additional pension contributions, people take on, say, £2 of debt, because debt is more expensive, then they're going to end up in a less secure financial position for retirement. Their net saving is negative. The other element you need to take into account to assess the benefit from a retirement intervention is whether people face a retirement shortfall. So if people are fine on their own and they don't have any retirement shortfall, then getting them to save more for retirement doesn't create any benefit. Okay? Conversely, if people are saving too much, it's a negative shortfall, then getting them to save more is bad because they're already saving too much and you're pushing them to save even more. So with this very simple framework, we can start to think about what is a good retirement saving policy. So first, I can tell you what is not necessarily a good measure of a good policy. A good policy is not one that creates the most increase in retirement contributions. Instead, a well-targeted intervention is one that increases the retirement contributions of people who face a retirement shortfall without crowding out other assets. And conversely, a poorly targeted intervention is going to be one that's going to increase the contributions of individuals who are not facing a shortfall and who are merely shifting their savings from a non-retirement to a retirement account. So an example, if you have an intervention that increases my retirement contribution, that's probably a pretty poorly targeted intervention. I'm a finance professor studying retirement, probably don't face a retirement shortfall, and I save a lot outside of my retirement account. So if you give me a financial incentive to save, I'm simply going to take some of the money I'm putting right now in my checking account or my brokerage account, put it in the retirement account, get the benefit without creating any new saving, and for someone who's not facing a shortfall. Okay? So now I'm going to go over these studies, and I'm going to try to think about what we learned from these studies about these different trade-offs in designing and targeting retirement interventions. So first, let's look at the first direct effect. These policies hopefully get people to save more for retirement. And here I'm going to ask, what is the effect of saving nudges over longer horizon? I'm going to do this in the US context. I'm working with a US 401k plan provider, so it's defined contribution benefit provider. It's quite large, that has over 4 million customers. What's interesting about this US setting is that here we're only changing the default option. We're not changing financial incentives or other features of the system, which is quite different from the UK auto-enrollment policy that is both a nudge, changes the default, and changes financial incentives. And so here what you see in the x-axis is your month of hire relative to the policy adoption. So we're going to look at people who work in the same firms. These firm adopted auto-enrollment, let's say in June. If you're hired in May, you're not auto-enrolled. You have to opt in. If you're hired in July, you're automatically enrolled at 3% in this setting, and then you have the option to opt out. Everyone faces the same financial incentives. And so this is looking at 30 different US firms. What you see is that after 1 year of tenure, look at people in their 12th month of tenure, those who are auto-enrolled participate a lot more. Participation is over 90%, double participation rate. And over 1 year, they accumulate roughly 40% more in their retirement account with significantly larger cumulative balances. Okay, so this is, and each dot is a month of hire relative to the policy change. So people in the same firms hired at different times. This is the kind of evidence that motivated the adoption of auto-enrollment across a lot of settings, a lot of countries, and in the US now auto-enrollment is becoming an obligation for all new 401k plans starting in 2025. But now if you follow people over time, things look a lot different. So if you look at the same set of employees after 3 years of tenure, the auto-enrolled are still participating at higher rates, although the non-auto-enrolled kind of catch up over time, and their participation rate reaches 70%. And if you look at their cumulative contributions, how much over the 3 years they've accumulated, there is no statistically significant difference between the two groups. So what happened is that the auto-enrolled start earlier, but over time, those who are not auto-enrolled catch up. They wait a year, but then when they start saving at a higher rate, and over 3 years, they tend to have similar balances. Okay, so this is only telling us that a policy that may look like it's very effective in the short run have a different effect over a longer horizon, and we have to be careful about these different horizons. But this is an average effect. And hopefully with the conceptual framework I laid out in the beginning, a good policy is not one that creates the most increase in savings on average. It's really about the distribution. Whose savings are we increasing? And so here, even though the policy's average effect is mitigated over 3 years, it's very interesting and, I believe, desirable distributional properties. So this is the cumulative distribution function of balances after 3 years in red are the auto-enrolled. So what this is telling us is that at the median, they have roughly 9% saved in their balances. What you see here is that at the median, there's no difference between those who are hired before and after auto-enrollment. At the top, if anything, the policy, because the default is quite low, is pushing and anchoring people down and pushing people to save less. However, at the bottom of the distribution, if you look at the 25th percentile of balances, those hired under opt-in are not saving anything, so they have 0. Those hired under auto-enrollment have accumulated over 3 years roughly 9%. Okay, so that means that even if the average effect of this policy is perhaps 0, it creates a lot of savings at the bottom. And so going back to this framework, if we believe that those who are at the bottom of the savings distributions are those who are facing the largest retirement shortfall, then this policy is actually quite desirable because it increases the retirement contributions of those facing the largest shortfall. Next, let's think about this question of shortfall and the distribution effect of these policies. So here we're going to think about, the first one was on nudges, now we're going to think about financial incentives. We're going to think about the distributional effect of financial incentives. So this is joint work with Jonathan Rothbaum from the US Census Bureau, Larry Schmidt from my colleague at MIT, Jorge Colmenares from Harvard, and Cormac Wedea from Yale. And it's a very exciting set of data. So we're working with the US Census Bureau, and this only reflects our views and not those of the US Census Bureau. And so we have access to over 10 million individual tax records that we've merged with new data we've collected on retirement plans. And so we can see people, we can see their families, we can link you to your parents, to your children, to your spouse, and follow you over a decade. So what do we find? In the US, every year, we spend 1.5 percentage point of GDP in subsidies for retirement saving. There's roughly $120 billion in tax subsidies, tax expenditure for promoting contributions to DC plans, and 180 billion from employers, mainly in the form of matching contributions. The way it works, you put $1, my employer is going to put 50 cents or $1 in the plan up to some match. So the design of this system of financial incentives is such that if you do not contribute to the account, you don't get the tax subsidy and you don't get the employer match. Okay, so this system is going to reward those who can and do save more for retirement. So what are the distribution effects? First, we can look at what this means across different racial and ethnic groups. The average white American worker contributes 4.6% of their salary every year to a retirement account, whereas the average black or Hispanic worker contributes roughly 3%. Now, if you contribute more, you're going to pay less in taxes, and you're going to get more from your employer. Once you take this into account, you see that these subsidies are going to make these gaps across racial groups even larger, by giving more to those who start with more. What's interesting is that most of this gap remains even when we compare people who have the same income, who have the same level of education, who are working in the same occupation for the same employer in the same county. Okay, so even within the same firm, two people who have the same job description, these financial incentives are going to mean that the employer is going to give more to their white workers, and that white workers are effectively going to pay less in taxes. And what's interesting is that these distribution effects and the regressivity of these incentives is true by income, and that's kind of well documented. High income workers tend to benefit more from these incentives. In fact, if you move from the second to the 9th decile of income, contributions go up by 1.3 percentage point. But even conditional on income, if you compare two workers with the same income, race is going to matter almost as much as income. Education is going to matter. These subsidies are going to benefit more to people who have a college degree. Family structure, if you are a two-person household, you're more likely, you probably have less liquidity needs, and so it's going to be easier for you to take advantage of these subsidies. If you're a single parent with kids, it's going to be much harder to get these subsidies. If your spouse is richer, you're more likely to take advantage of these subsidies. And we can also link people to their parents. And so again, you see if you compare two workers in the same firm, in the same occupation, if your parents are richer, you're more likely to take advantage of these subsidies, you're going to pay less in taxes, and get more from your employer in terms of employer contributions. So what this is telling us is that even if these financial incentives can create new retirement contributions, they're probably quite poorly targeted because they exacerbate inequalities and they're going to increase the contribution of people who perhaps have faced lower retirement shortfalls. If you have richer parents, then you probably have access to, you're probably going to inherit, and so maybe you're not going to face as large of a retirement shortfall. If you're in a two-parent household, perhaps you have less of a retirement shortfall. Okay, so we have to be very careful not only about how much retirement savings are created, but who's being targeted and who's benefiting, and how is inequality changing as you change the allocation and you change the policy design. Now we can move to the UK. And here we're going to ask, and that's going to link to what we discussed and what we'll introduce previously, did the UK policy that combines a nudge and a change in financial incentive crowd out other forms of savings. And here we work with the UK financial institutions, and we have bank account data merged with credit card and loan data, and all of this merged with pension data. So we see what you're doing in your pension account, how much you're contributing to the pension account, but we also see how much you're spending on your credit card and your debit card, loan, or if you have a mortgage with this specific financial institution. So here, we're going to take advantage of the rollout of the auto-enrollment policy and the step up in the default. This is a simplified description of the policy variation. One thing I've learned from starting to work on UK data is that the policies are always more complicated than they seem like, and there's tax relief, and there's different definition of what pensionable pay is. But from a bird eye view, what the policy did is that if between 2012 and 2017, the minimum total default was 2%, with at least 1% coming from the employer, effective on April 1st, 2018, this was stepped up to 5%, with at least 2% coming from the employer. And again, in April 2019, it was stepped up again to 8%, with at least 3% coming from the employer. And so what we're going to do here is we're going to compare people who were affected by the policy to individuals who were not affected by the policy. So if prior to April 2018, you were contributing 2%, 3%, or 5%, then in April 2018, the first two groups saw an increase in their contribution, whereas those who were already contributing above the new default did not see a raise in their pension contribution. And again, in April 2019, those who were already contributing 8% or above did not see an increase in their pension contribution, whereas those who were contributing below saw an increase in their pension contribution. And so what we're going to do here, this is joint work with Christopher Palmer, we're going to look at the same individual behavior before and after the change, and we're going to compare them to other people who were not affected by the policy. So what do you find? When you increase pension contribution by £1, take-home pay goes down by roughly 67 cents. What this means is that for a £1 increase in pension contribution, roughly 2/3 is going to come from the employee, 1/3 is going to come from the employer. So you should see your take-home pay, the money that's deposited in a checking account every month, go down by roughly 67 cents. Okay, so that's what we predicted and expected from the policy design. Then we see that total spending goes down by roughly 23 cents. So between 30 and 40% of the drop in take-home pay is financed by cutting spending. What's nice here is that we have detailed spending data, so we can see where exactly are people cutting their spending. We see that the main categories that are dropping are leisure and restaurant. We also see a small drop in housing and utilities, but here utility includes things like your Netflix subscription. So it seems that people are able to accommodate this large increase in pension contribution through, in part, cutting down their more discretionary spending, whereas other categories, such as supermarkets or consumer retails, do not seem to be responding a lot. Next, okay, so if 23 cents come from spending, how is the rest financed? So here it seems that people are mostly running down their checking account balances and racking up a little bit more in credit card debts. Whereas savings account balances don't seem to respond. Okay, so this is what you see in the data. This is the first increase in the default of April 2018, and this is April 2019. So if you look at credit card debt, it's relatively flat between those who are affected and not affected prior to April 2018. And then as you increase the default, people start accumulating more and more credit card debt. We can do the same thing with checking account balances. The magnitude are actually larger, so most of the increase comes from checking account balances, and you see a drop in checking account balances. Finally, we can look at heterogeneity, and that's going to be important if we want to think about targeting. If we look at people in March 2018, before these policy changes, and we group them and we put them in 3 bins. The bin for people who have the lowest amount of liquid savings, the least amount in their checking account prior to the policy, those with moderate amounts, and have been with the top tercile of liquid savings in their checking account prior to the policy. What we see is that those who didn't have a lot of savings to start with had no other way than to cut their spending in response to this policy. And so for those with the bottom tercile of initial deposit, we see a drop in spending that almost covers for the whole drop in take-home pay. Whereas for people with larger initial deposits, so if you had a lot of money in your checking account and the government increased the required retirement contribution, then we cannot reject that you did not change your spending pattern. You know, if you have a lot of money in your checking account, you don't need to forego going to the restaurant, you don't need to change your spending pattern, you're just going to use some of the money that's sitting in your checking account to finance your consumption and reduce your checking account balance to finance increased retirement contributions. So, what do we see here? We see partial crowd out of credit card and checking account balances, especially among those with large initial savings. So if we go back to this framework, what does this tell us? Well, you probably don't want to target people who have a lot of liquid savings. Because people who have a lot of liquid savings are merely going to move money from, say, the checking account to the retirement account, rather than change their spending pattern. And so they're going to have large crowd out. And these people are also probably those who face the least retirement shortfall. If you have a lot of money in your checking account or a lot of deposits, then you're probably quite patient, you're probably good at saving, you don't face a lot of liquidity risk, and so you may not be a priority in terms of where we want to target these interventions. So this is kind of very briefly going through a lot of evidence and a lot of different data sets, but I want to take a step back and try to think, what do we learn from this about what are the takeaways in terms of designing retirement policies? So the first takeaway, if you have to really remember one thing from this talk, is you must look beyond average effects. You know, if a policy increases retirement saving by 10%, it may be a good policy, maybe a bad policy, may make things worse. That's not very informative. What really matters for a policy is whether it creates the most increase in retirement savings among those who face a retirement shortfall and who have large spending responses, who are actually changing their consumption in response to the policy. And through the evidence we have from the UK, it seems that a good indicator of having large spending responses is to have low initial savings. People who have less savings tend to have large spending responses and probably face a larger retirement shortfall. The second takeaway is that putting income or asset caps can be efficient. We usually think about capping retirement incentives from a distributional or redistribution perspective. You know, we think we don't want tax subsidies to only go to high income people, so it's more of a distribution argument. What we learned from these studies is that it's not just about, even if you don't care about redistribution, even if all you care about is efficiency, it can be a good idea to put caps. Because getting very wealthy people to save more in retirement is much harder. Most of the time when you create incentives and they take up those incentives, they're simply going to move money from one account to the other rather than create new savings. And so encouraging the retirement contributions of wealthier households is both inefficient because it merely shifts the location of existing savings and regressives. And here I think the UK is doing much better than the US. I think the allocation of tax subsidies and the design of these policies is a lot more income and asset tested in the UK than it is in the US. Finally, I think this highlights some risk with increasing defaults because it could worsen the quality of the targeting of these policies. So the risk here is that if the most liquidity constrained household opt out when you raise the default, then the policy becomes less efficient, okay? So you put a higher default, let's say at 10%. The only people who stick with the new policy are those who have more comfortable finances, who have large levels of savings, but these people, you know, are simply going to change the location of their savings. So the policy is going to become very inefficient because these are the people who have the least the smaller spending responses. And so even if you're creating more contributions to the retirement accounts with these higher defaults, you're worsening the quality of the targeting, because you're losing those who are most policy relevant, those who actually face a retirement shortfall, and who have large spending responses. And here, maybe a word about this, I have other work that I did not talk about that actually shows some of this. You do see that when you increase the default, in the US, we looked at firms that increase the default by 1%, 2%, 3%, 4%, you see more and more people opting out. And that means that we may be losing the people we care the most about, for whom these policies are efficient and who are likely to face a retirement shortfall. And that's all I have for today, and I'm really excited to open up the conversation and hear your thoughts.
Thank you, Taha. Now, I'm afraid we're bound by the constraints of the timing of our live stream, so we're not going to have a huge amount of time for open questions from the floor right now, but hopefully we can continue this discussion after we continue that section of the day. But Joe, I was thinking this might mean it's a good time to throw in a couple of questions if we have any from the remote audience.
Thanks, Matthew. Thanks, Taha. So yeah, a couple. Firstly, IFS research a while ago concluded that people at the start of their careers shouldn't worry about pension saving. This can happen after age 45. What do you think of that? And then, secondly, what does your research tell us about how the UK auto-enrolment policy should respond to the cost of living crisis?
Okay, 2 points. That's kind of a difficult question. Should young people save more for retirement? So on the one hand, we talked about this. You may have other financial goals. You may want to repay your student loans, build up money for a deposit to purchase a house. But then these are also the people who would benefit the most from compound interest. People in their 20s are less likely to have children, so consumption is less valuable to some extent. It's easier to create, to have some flexibility to save more when you don't have children, when you live in a smaller place because you used to live in a smaller place. So it's not obvious to me. I mean, it's going to really depend on the policy goal. I played a little bit on modeling, and it's not clear that the optimal default for younger people should be lower. That's going to, yeah. So I don't have I think there are arguments to be made. I think compound interest and longer horizon may make it more desirable. If we think that we move into a world where rate of returns are potentially lower going forward, then getting younger people started on saving earlier may be a good idea, because it may be harder for them to accumulate the savings needed. But it's going to be contextual. And on the second question, what kind of adjustment to the UK auto-enrollment policy? The fact that we see an increase in credit card debt is a little concerning. And so I think that should be an area of focus. Perhaps giving access, making these accounts a little bit more liquid could have could be positive. It's kind of surprising that opt-out rates are still quite low. They're still at 9%, but that already raises a question about the distributional effect of this policy, because those 9% who opt out are probably lower income, are probably people who are more in need, are probably those who are least ready for retirement. And given the design of the policy, we're saying that they're going to get 3% less in compensation from the employer, because by opting out, they lose the employer contribution. And so I think that already raises an issue that, for the bottom decile, this policy means that we've decided that the bottom decile in terms of ability to save is going to be paid 3% less. If going forward the policy increases even more this minimum employer and employee default contribution, then I think this concern becomes even larger. And I'm not sure I would be in favor of increasing. I think we just have to be extremely careful with increasing the defaults, and we have to be very sensitive about those who are left out, either staying in the system and accumulating more credit card debt or those who opt out of the system and are effectively paid less.
Great, thank you. I wish we had more time for questions. We obviously, as I say, do have much more time for discussion in the room in a moment, but we do need to close out the live stream section of our day. So glad that those questions came from the audience, because it meant that I didn't need to ask exactly the same questions of you. So well done everyone for having the same thoughts as me. I just wanted to say again, just to finish off today though, that one of the things that really strikes me from looking at Taha's work is just what a difference it makes who you are, what circumstances you're in, who's in your household, and what's in your bank account. And trying to design policy interventions, as Taha's just been alluding to, that are blanket and that meet the needs of all those different groups of people is really hard, and that's hopefully something that can trigger a lot more discussion within this group and going forward. But for now, first of all, I just wanted to thank Taha very much for a really fantastic talk and for bringing all this really useful research here to the UK. And finally, to introduce Gemma Gooch, who's with us today, who's co-head of Global Social Impact at BlackRock, and she'll just be closing the live stream portion of our day today. So please welcome Gemma.
Thanks, Matthew, and also thanks, Taha, as well. Good afternoon, everyone. As Matthew just said, I lead our philanthropic team, our social impact team at BlackRock. And in that capacity, I was delighted that the Nest Insight team asked me to close today's live stream in our capacity as a strategic partner with the Nest Insight team. So in that role, I've had the privilege of attending several conferences now put on by the team and seeing the depth and the breadth of learnings really grow over time. And once again, it's been a brilliantly organised and thought-provoking day, as I'm sure you will all agree. I'm always inspired and actually really positively encouraged at these gatherings around the shared alignment, the passion of everyone involved, which was clear from all of the depth and the real richness of questions that I heard in the room today, and the innovation happening across employers, across financial providers, research institutions, funders, everyone in this whole ecosystem, all helping to strengthen the economic security of those who need it most. Today has been a really important reminder of the complexities involved in addressing short-term financial volatility and financial well-being long into retirement, and the multi-layered and comprehensive solutions required. We've heard today about the role of employers and the employer-employee contract. We've considered the increasing cost of home ownership and cost of living, and the extreme impact of the lack of home ownership in retirement, and the innovations in pension-backed loans from South Africa. And from Taha, evidence on what constitutes a well-targeted retirement intervention, and obviously the complexities around the different individual circumstances of everyone. As we've heard, thanks in part to the work of many in this room, the last decade has seen a huge progress in the provision of pensions in the UK through the introduction of auto-enrolment. However, as the speakers and panellists have made clear, there is still much more work to be done to build on this success and to further strengthen the financial security of households and individuals across their lifetimes. The pressures of the current macroeconomic backdrop are only making things harder for too many people. At BlackRock, we help build better financial futures by managing the pensions of millions of people in the UK and around the world. But we know that financial well-being is a journey that requires multiple interventions at different points in time. That's why the Social Impact Team, which I co-lead, launched our Emergency Savings Initiative in 2019 to help those on low and moderate incomes in the US and in the UK save in the short term so they're better able to plan for the long term. As part of this initiative, we've had the pleasure of supporting and working with the amazing Nest Insight team. And a few weeks ago, we published the Emergency Savings Initiative and Emergency Savings Initiatives Impact and Learnings Report, which looks back at the impact generated over the last 4 years. The report highlights the intersection between different financial security interventions, and in particular the relationship between short and long-term savings. And one of the key findings is that emergency savings and workplace savings do not cannibalise retirement savings, but rather protects them by providing households with a financial safety net on which to rely, instead of having to forego saving for retirement.
This is a really significant lesson for both employers and employees, but also policymakers. And we're delighted that in the US, BlackRock funded research in partnership with the Commonwealth, Common Sense Lab and the Financial Health Network over the last 4 years has helped inform aspects of the Secure 2.0 legislation. These research and policy developments, together with conversations like the one we've had today, are helping us approach financial well-being in a more holistic manner, in which pensions and retirement savings continue to be a driver of financial well-being, but can be strengthened by complementary initiatives around home ownership, emergency savings, and other innovations. Last year, we extended our commitment as a strategic partner to Nest Insight to continue to fund their emergency savings programme, as well as launch exploratory research to explore parallel paths to advance long-term financial well-being. Today, I'm really pleased to announce we'll be providing additional resources to strengthen Nest Insight's external engagement efforts by redoubling our commitment through a new grant that will fund further stakeholder engagement, supporting communications, marketing and outreach resources to help scale and build a more frictionless workplace savings architecture. We see this as a natural next step to scale the programme's reach and impact with employers and policymakers, now that there is a substantial body of evidence that we can point to. I'm confident that our evolving partnership will continue to produce groundbreaking insights and advance the financial well-being of families and households across the UK. Finally, today I have the pleasure of closing the proceedings and saying a massive thank you to everyone who has made this event possible. Thank you to everyone at Nest Insight for putting today's event together, including those all working behind the scenes in particular. Will and team, today has been yet another testament to the amazing work you do and your commitment to this cause. And to the panellists, moderators and speakers, thank you for your insightful contributions. So thank you, that's all from us. And also, apologies, I should be thanking all of you who have joined online, as well as those in the room. We know that you've got many demands on your time and appreciate your contributions, in particular in the questions through Slido. That's all from us today, so please enjoy the rest of your day, and goodbye.
So I won't feel very